you just a couple quick clarification questions regarding the contingency reserves. In the model, are contingency reserves released during the simulated contingencies and restored within the NERC required time frame?
That actually, Mr. Weathers is
okay. All right. Sorry, Mr. Weathers, you're the expert.
Yeah, I can speak to that. One thing I wanted to also clarify, I think we talked about contingency reserves earlier, is trying to define those. We mentioned a 90-minute units capable of responding within 90 minutes. I believe that should be 10 minutes. So you got contingency reserves, you have spinning and non-spinning contingency reserves. And so the non-spinning, I believe, 10 minutes should be the response. Okay. So can you repeat your question, please?
Certainly. In the model, are contingency reserves released during simulated contingencies and restored within the NERC required time frame?
Yeah, in the model, we do model the operating reserves, including the contingency reserves, according to our operations guidelines. And so we get that guidance. I think we spoke about it earlier. There's some NERC guidelines, and also the what our operators actually use to determine when they shed firm load are the same things that we model in our system. So contingency reserves are a part of that. And so we do model those in our system according to the way that operations has those implemented.
Okay, so they're modeled based on the NERC guidelines.
That is correct.
Okay, thank you. And then on the generation remix questions, in the study were the three resources that were studied: the photovoltaic utility scale, photovoltaic distributed scale, and wind. Those were the three resources
that were filed as illustrative examples.
Okay, all right. Yes. For those illustrative examples, then, why is there such a huge? Why is the photovoltaic utility scale on the negative side, where everybody else is very positive and very cost? Looks like the remix costs are so much better.
So just to clarify, you're asking specifically about remix costs?
Yes, sir.
Okay.
Yes, sir.
So specifically the remix costs. Remember, Commissioners, what I talked about earlier was the profile of the specific resource is what impacts how the rest of the system has to operate. Excuse me. So, for example, when we evaluated a 1,000-megawatt tranche of distributed solar, we assumed a diverse set of resources. As a matter of fact, solar, if it's on rooftops, some rooftops may face east, some may face west, some south, and we took that into account in the development of the generic profile overall for the DG solar. And that profile, when we apply it for the remix, it is what makes its value different. It's a non-optimized profile because of our diverse assumption of the direction that they're facing versus the utility scale, which it would be, our assumption there, it is more optimized because we assume it's a larger facility and you're able to specifically address and optimize its energy production.
Okay, but wouldn't, based on that, wouldn't you think that the utility scale would be, have a better cost relationship, in fact be more cost effective than, say, distributed generation and wind? Why is it not more?
And you're focused on just that one component. You're asking just about on generation remix.
Generation remix cost.
Okay.
And it just seems a little unusual that the utility scale is not as competitive as the other two.
Right. You have to remember, again, there's significant difference in those profiles. Just for example, the amount of energy in the 1,000-megawatt tranche for the utility scale is probably 20 to 25% more than the amount of energy in the distributed because, again, of the non-optimized production. And that's a significant difference in the overall profile. And so we take that into account when we actually do the generation remix evaluation.
All right. Thank you for that explanation. And Dr. Smith, just a quick clarification for you. Would you agree that if you have lower cost resources, don't they produce total lower system cost?
assuming that those costs are lower, then it would be lower system costs.
Right. So if you have a resource that produces as a low-cost resource, that's going to have a similar impact on reducing the total system cost, wouldn't it?
I would agree with that, yes.
Generally
That's
statement.
in general,
General
yes.
statement, yeah,
General statement,
okay.
yes.
And that would also have an impact in lowering the total revenue requirement for the company, if you had lower system cost?
Other things being equal, yes.
All right, thank you very much. All right, I have handed to you for your review SACE exhibit number 1, which is page 35 from the Nexent report, evaluation of Georgia Power Company's 2017 DSM programs, volume 1. And you have that in front of you.
Yes.
Okay, thank you. In the report, in this report, the program administrator cost test score, is that higher than 1?
So are you talking about the ratio?
Yes, we are.
It's 6.1.
6.1. And was that the utility cost test score?
That's correct. It's the same as program administrator cost.
All right.
Same
And,
test.
excuse me.
Yes, same test,
Oh.
just different names.
Oh, thank you.
Mhm.
Does the utility cost test score of 6.1 indicate that for every dollar invested in energy efficiency, there are $6 in reduced utility system cost?
That's correct. It's a cost-benefit ratio, so...
We've been through that.
Not this one.
Okay.
I think we've had some other discussion about other cost benefits, but this is, I'll move it along. But this is showing a positive 6-to-1 ratio, is that correct?
That's right. And I would also point out that this is just one of the measures that we'll look at as we evaluate the DSM programs.
Understood. Is it common for DSM portfolios at major utilities to achieve utility cost test scores in the range of 6.1?
I haven't looked at the other utility scores, so I can't speak to that.
All right, thank you. Does a utility cost test score 6.1 indicate, that's already been asked, would increased deployment of these programs likely return continued financial benefits for customers?
Could you define financial benefits?
Well, we have the 6-to-1 ratio benefit here. If for every dollar invested in a DSM program, it's returning $6. Wouldn't that be a benefit for ratepayers and customers?
I would say that DSM programs does not have a uniform impact on all customers. So for participating customers, and this program administrative cost really doesn't say anything about benefit for customers. It really speaks to the cost from the utilities perspective because it's weighing the avoided cost on the utility system versus the benefits, which is versus the cost of implementing those programs. But from a customer perspective, if a customer is participating in the program, they would definitely benefit from it because they're reducing their usage. But non-participating customers would not necessarily benefit because their rates are going up, but their usage is not going down. So it's not a uniform benefit across all customers.
But didn't you agree that by lowering total system cost, that provides a benefit overall?
It's a benefit in that we have lower costs, but it's also true that the utilities revenues are going down. So we need to raise rates to collect the fixed costs of our system from the customers. So if the customer is not participating in the program, all they're seeing are higher rates, and that's what I was referring to when you say benefit for customers. It's not uniform across all customers.
All right, thank you. So are you saying that cost-effective investments in DSM don't reduce utility system cost, or do they?
I mean, avoided cost by definition is lower utility cost. And if implementing those measures, the cost of implementing those measures versus avoided cost is less, That's a correct statement. But earlier you were asking about benefit to customers. When you talk about benefit to customers, you have to look at ones that are participating and ones that are not participating. And that's one reason why we actually look at multiple measures, because these programs influence different stakeholders in different manner.
The last question was more system-oriented, not oriented towards individual participants or non-participants in the DSM programs.
Okay.
And don't lower utility system costs mean lower utility revenue, well, and lower the average customer bill. Okay. And I just paraphrasing Commissioner McDonald's statement about everything has a cost. So don't all energy resource additions come with costs that impact the utilities revenue requirement?
That's correct. Everything has a cost.
Okay, and I think your testimony to Mr. Ebersbach established that the company's consideration or emphasis on rate impact tests results in excluding programs and measures that the company's analysis showed to be cost-effective under cost-effectiveness tests. Could excluding those programs and measures mean that customers ultimately pay more for supply resources than DSM resources to meet equivalent capacity needs?
Could you repeat that question? It was a long
Sure,
question.
certainly. Sorry.
Just to make sure I understand that.
Do you want it from the beginning?
From the beginning, thank you.
Okay, all right. I think that yesterday we established that the company's consideration or emphasis on rate impact test results in excluding programs and measures that the company's analysis showed to be cost-effective under cost-effectiveness tests. Okay, the question is, could excluding these programs and measures mean that customers ultimately pay more for supply resources than DSM resources to meet equivalent capacity needs?
Equivalent capacity. So, I mean, I would go back to my prior answer. So you're saying would customers pay more in the end, and it depends on which customer, right? The customers who are implementing these measures will pay less, and the customers who are not implementing these measures will pay more because there's a rate pressure. And I would also disagree that we are over-relying on the RIM impacts, because over time, although the RIM impacts have increased significantly, I think back in 2013 it was less than $100 million. Now we are at $230 million, $238 million on a net present value perspective. I wouldn't say that we are overemphasizing RIM. We are trying to balance that economic efficiency that we talk about with the TRC test that does not distinguish among stakeholders with the upward pressure in rates.
But under that understanding that the benefits have been reduced for some DSM programs, but if they're showing a positive, if they have positive as opposed to an alternative, positive value as opposed to an alternative capacity resource, shouldn't they be
I would say
evaluated?
Positive what? Because the positive TRC, total resource cost test, yes, all in all, from a societal perspective, there is a benefit. That's the reasons why we're doing these programs to begin with. But it does not distinguish with stakeholders. If it's a positive RIM, well, it does not have a positive RIM. It's a positive participant cost test that is good for the participating customers. Otherwise, we would not do them. So it depends on, when you look at when you say economic, it depends on whose perspective you are looking at it from.
Would a DSM if DSM programs provide relief or provide an alternative to building new generation capacity, isn't that a benefit?
That's the benefit, and we account for that benefit with the avoided cost. We also account for any transmission and distribution investment that we avoid on top of that.
Okay. All right, thank you. I guess what I'm trying to say is if you could invest in 3 megawatts of capacity savings through energy efficiency over the next 3 years, might the same 3 megawatts of capacity cost more if it was a gas peaking plant, for example?
I think talked earlier, that's not a fair comparison because a gas peaking plant is a dispatchable resource, and DSM is not in the context of energy efficiency. So comparing those costs ignore the benefits that go along with those costs.
This
So I think
dispatchability, dispatchability has a positive value that overrides or is weighted heavily.
I would say because of their characteristics, we evaluate those two different resources differently. So when it comes to the supply side resources, it's evaluated in the context of the expansion plan. And in the demand side programs, because they have different impact on different stakeholders, we use the commission approved process to evaluate the demand side resources. And I think we talked about that already multiple times.
Okay.
But as we've stated, when the economics of the benefits of those DSM programs are looked at, it does look at when we have a capacity need and prices what it would be to build a CT into that evaluation. So we're capturing that in terms of those are your two alternatives. So if DSM can save you some capacity, that's what we're comparing it to in that evaluation. But as Dr. Smith has said, there's a lot of different considerations for both projects because they're different by nature.
Would it be fair to say that no one in the DSM working group believes that the aggressive case is a realistic or desirable strategy?
I do not know that firsthand.
Okay. Does anybody on the panel have any experience with the demand side working group?
Dr. Smith.
Dr. Smith. Did you attend the demand side working group meetings?
I do. Well, just for the past less than a year or so, because I'm new in the group.
Oh, okay.
So I think last 7 meetings, maybe 6 meetings, something like that.
Were there any participants in the demand side working group that were supporting the aggressive case?
I don't recall the specific conversations around aggressive case
Okay.
this time around. We talked a lot about the advocacy case that we, sensitivity that we put together, but I don't recall any conversations around the aggressive case.
Well, what about the advocacy case? I mean, was there support for the advocacy case?
It was the case that was presented to us by the demand side working group, so I would assume that they would support that.
Okay. And does the company evaluate energy efficiency programs from other utilities?
What was the last sentence, last
Does-
few words there?
Does Georgia Power evaluate other energy efficiency programs with other utility companies?
Do you
The
mean
programs that other companies have?
Yes, sir.
Do you mean we compare, look
Yeah.
at them?
Do you ever
I
look
mean,
at Duke and some, Entergy and others and look at what they're doing in DSM and compare it to what Georgia Power has?
Yeah, I mean, we have a energy efficiency group. I'm not a part of that, but part of their responsibilities involve going to conferences, talking to other utilities. So I'm sure that they're aware of other programs across the country.
Well, I mean, if you do look at other DSM programs with other utilities, do you see which ones are producing positive results and are beneficial and look at those as potentially copying them or using them as models for the Georgia program?
The primary driver of the programs that we select are whether or not it will work in Georgia. But we also consider any kind of learnings and best practices or program ideas from other areas as well. But it has to work for Georgia and Georgia customers.
Okay. Well, what if just hypothetically, what if one of those programs showed that it provided really benefits below avoided costs? Wouldn't that be something that you'd want to explore and consider implementing in Georgia?
Whose avoided costs are you speaking of?
All right. Well, it'd be their avoided cost, but I guess you would say you would compare their avoided cost to what Georgia Power's current level is, and see if there's a relative comparison, and if there might be a benefit for Georgia Power. Obviously, if their avoided costs are much higher than Georgia Power, that's not going to be a fair comparison.
We wouldn't necessarily go about it that way. It's really getting the program ideas from the other states or other areas that work for the states and really looking into whether or not it would work in our territories. Because if you think about, you give an example of maybe Duke or maybe California, different areas, they have different weather patterns, different characteristics, so different household mixes. So it has to work in our state for us to consider it.
You could also have differences if that's a program that's been established. They would have vendors established and everything too, right? So we would have to look at what the implementation would be in Georgia. But yeah, you could get an idea, but you still have to look at what the impact is to our system.
All right, thank you very much. If the DSM portfolio is projected to represent approximately 10% or 1,600 megawatts of the company's peak demand by 2022, what percent of the company's peak demand does the DSM portfolio currently represent?
That's what it currently represents as a percent of 2022. As a percent of, I mean, when you say currently, so maybe you should clarify what you mean by that. Today?
Today.
I haven't made that calculation. We did a 3 years out calculation to be consistent with our 2016 IRP.
Okay, so you don't know.
It would be a different number because if you look at what's behind that $1,600, we talked about that earlier. We have the real-time pricing. We have interruptible supply. Those, and they have different values for different years. It will be around that number, but it won't be exactly 1,600 megawatts.
So you don't know what the current peak demand that is represented by DSM today?
I don't know it at this moment. I haven't.
Okay.
I don't have the numbers with me to tell you that.
Okay. Would you have those easily accessible to you?
Right now?
No.
Later,
I mean,
yes.
Could I ask you to provide that to us?
So it's a hearing request?
Yes, please.
Yeah.
Okay.
Thank you. Is the participation in the residential thermostat demand response program limited to only total electric homes?
We are going to focus on total electric homes to get the biggest bang for the buck. That is correct.
Okay.
That will be our focus. And one thing that we are looking at with the thermostat demand response program is to get response in the winter and in the summertime. And if we focus on all electric homes, we get the most potential for the response.
So if somebody has a gas space heating, they're not qualified to participate?
That will not be our focus area, no.
Okay, so they're disqualified from participating?
So the way we designed the program in the planners currently, these are the planning level assumptions, we plan to focus on electric only homes. Now, during implementation, some of this might change, but that's not the current plan.
As a gas customer, right? I protest.
But we can't call on you in the winter time.
All right. Would you please refer to staff exhibit, staff response PAI-11 and the trade secret attachment?
Do you have that response?
I do. Let me just show it to you first. This is the public disclosure. I'm going to give it to you. And the trade secret response is on the back, is attached to it, and I'm going to ask you a couple questions about it. So if you don't have it, Mr. Chairman, may I show them this place?
So this is an attachment to,
That's the
The
response
response.
to the data request.
Do you have the
it's
question?
yeah, do you have the questions? This is just an attachment.
No, I don't have the question.
Okay.
All right. And my question is, why is it trade secret?
I'll object because every trade secret response that is filed as trade secret has an assertion that explains in detail why the information being provided as trade secret. We haven't provided that to the witness.
I appreciate the objection, but it's a report regarding customer response to light bulb efficiency programs. I just could not find trade secret information in there for the life of me. I just wanted to ask if they knew why it was trade secret, so I'll move on.
Thank you. Trade secret is trade secret.
I understand. I didn't want to, but I mean,
Move on.
I couldn't find anything that was trade secret unless they want to keep it secret who the what hardware store they talked to or the home improvement store. But generally, just looking at this response, would this, Dr. Smith, looking at this quickly at this response, do you think that information might be helpful to share with the demand side working group folks to get their feedback and assistance in improving the program?
Yeah, I mean, we did, this is looking at, let's see, what it appears to be evaluation results for residential lighting program, and we do talk about evaluation results with the demand side management group.
Oh, so that was shared,
I don't know if this document was shared with them, but the discussion and presentation happens in the DSM working group, and they're free to ask any questions that they might have.
Okay, all right. It seemed a little innocuous to me, but anyway.
Is that a question?
Yes, sir. No, it's, staff exhibit JKA 3-6 asked you whether you had studied programs to reduce the saturation of electric heating that affects the winter peaks and leads to a different reserve margin target. I didn't see the specific idea discussed in your response. Do you have anything to add that would specifically address this question?
Could we see the data request? As Jeff indicated, we responded to a large number of those, so it would be good to see which one you're talking about.
We'll put these conversations on the record, if you don't mind.
Is anybody familiar with that response?
I
If
think we
not,
need to
we'll-
see the question to know what this is the answer to.
All right, thank you.
And Southern California level.
Okay, let's turn our attention to the additional sum, and I'll be asking you some questions about the calculation of the additional sum. As you've already discussed earlier, you're proposing an additional sum of 4 cents per kilowatt hour if you achieve the proposed savings, and 5 cents per kilowatt hour if you exceed your savings target by 20%. Is that correct?
Yeah, it would be 5 cents on the kilowatt hours only above the 120%, just to clarify that.
Right, correct. Can you, I'm going to hand you SACE exhibit number 2.
Okay. Thank you.
All right, have you all had a chance to take a look at that?
Yes, go ahead.
All right, it's a composite exhibit, but let me ask you a couple questions here. Can you please verify the data and calculations on this cross-examination exhibit marked SACE Exhibit 2?
I mean, it appears that it's the calculation that SACE might have done utilizing some data from the program planner. This is not a company calculation.
Well, it's based on company calculation.
That's right, I'm just clarifying that. So
No, this was created as a composite from company information created by SACE, so there's no
Okay.
misunderstanding.
Okay.
First, I'd like you to compare the forecast benefit to cost ratio for your DSM program from 3 years ago to the benefit to cost ratio for this year's DSM's program. Are they both 3.9? Is that correct?
So, I mean, one thing is I really can't verify this data.
We can't see the math.
At the point in time, at this point in time, I mean, I see the numbers on the table, but I can't verify what these numbers represent.
And would it help you if I gave you the data that they were based on from Docket 4016? Let me just,
Sure.
I'm going to show you, this is for the second chart there, the DSM Program Planner Summary 2017.
Okay.
Let me do the last half. I think it's what he's saying.
Okay, thank you, this is helpful.
This is from the 40161, which is the 2016 IRP.
Did you say it was 2016 IRP?
Yeah, that's the 2016 IRP,
Okay.
that's for the 2017 information, that chart there.
Okay, so
All
this
right.
is what we filed in 2016 IRP?
Correct.
Okay.
It's just for reference purposes, and
Okay.
see if it can help you answer the question or review the composite exhibit.
So this information would be the bottom portion of your spreadsheet you handed us, right?
Correct.
There's a comment that refers to tab E. I'm trying to figure out what tab E is. It's not marked as such here. And when I look at what is called program administrator test, it says tab E, and there's a number under residential, commercial, and residential, commercial, and total. When I look at the program administrator test here, I don't see the exact numbers.
Are you looking at the charts, the data from the 40161?
Yeah, I'm looking at the,
Which page? I can't.
this is page 5.
Page 5.
It says program admin. So it says,
Well,
I just have to object. It seems that he's trying to get Georgia Power's witnesses to verify a calculation that either he or his consultants have done in some way, shape, or form. I don't think this is the forum to do that. These aren't their numbers. They weren't witnesses in the 2016 IRP. And this chart, this exhibit, certainly is not something that they are responsible.
They being,
My witnesses.
oh, okay.
Mr. Chairman, what we're trying to do here is just make a comparison based on the company's information from their 2016 filing to the filing they've made today, just to show comparison between the cost
Well,
base.
make it quick.
All right. Yes, sir. Will do.
And what you're trying to make is a projection, correct? I mean, these are projected numbers.
No, these are actual numbers based on the company's filings from 2016 and today.
so
It's
if
just a
this is,
summary to.
if this is 2016 IRP, it has to be projected numbers.
For
Because-
17 and
Because
beyond.
actuals wouldn't have happened because it says 17, 18, and 19. Those are future years, so it would need to be a projection.
Right, I mean, but I mean, it shows forecast here. I'll try to move this on. In the 2017 numbers, it shows forecast and actual.
And the data you gave us from Docket 40161 has the forecast value in there,
Yeah.
but we don't know where you pulled the actual from.
Okay, so can y'all, I mean, can you respond to the question, or you're not going to be able to? And I'll repeat it for
What
you.
is
Just
the question?
Let me repeat the question, see if you can respond to it. Where is it here?
Was it that the 3.9 be
Yes.
solid?
Yes. Yeah, thank you.
Thank you. You're welcome. Yes or no?
I'm sorry, was
Still
there a
gonna need the
question?
question.
Let me
It's been
repeat
a
it
few
for him.
minutes,
That's
so.
like, if you compare the forecast benefit to cost ratio for your DSM programs from 3 years ago to the cost benefit to the benefit to cost ratio for this year's DSM program, aren't they both 3.9?
I mean, if you look at the numbers on this sheet that we couldn't really find in what you handed out to us, I see those numbers, but I can't really stand behind them.
All right. I mean, if the answer is no, then the answer is no.
Right.
I'm not trying to get you to
Right.
agree to something you don't know.
Yeah, my issue is when I look at what is quoted here for like 2020, it doesn't match what I see in this attachment. So program administrator test for residential class is in 2020, $17 million. Here I see $8 million.
Let me move on with
Yeah.
with this. We'll pass on
Okay.
on this chart and do the comparison. Let me just ask you this. Hypothetically, if the 2017 actual net benefit ratio was 3.9 and the 2017 Nexent report showed the actual net benefit ratio was 6.1, doesn't that mean that there was a projection of the projected ratio was over 50%? That the Nexent, excuse me, if the projection was 3.9, but Nexent shows 6.1, isn't that a 50% improvement over the projected ratio? Subject to check.
What does that ratio represent? That's my question. So we have
Mr.
program.
Baker, I understood the answer was that your issue there at the bottom of the page is your numbers, that they don't have corresponding numbers from the 16 RP that would mesh with that.
yeah.
Hypothetically, that's a good question, and I know how I would answer that, but I just wanted to put that in. Go ahead, Dr. Smith, make your answer.
I mean, I can't confirm these numbers with the data you provided, so I don't know how to answer that question.
Okay. I'm going to try hypothetical. Hypothetically, Dr. Smith, if you had a DSM program result that showed a 3.9% actual net benefit ratio compared to a DSM program result that showed an actual net benefit result of 6.1, would that reflect an improvement of over 50%?
I mean, those numbers, what you say is probably 50%, but what I would say is that when we talk about costs and benefits when it comes to DSM programs, we I think made the point that multiple stakeholders' costs and benefits will need to be taken into consideration. This is just looking at the label here, program administrator test. So it's just one of the tests that we look at, and it is maybe making the point that there is an improvement based on what's on this piece of paper, but it's just one of the tests that we look at. Even hypothetically, I can't make that statement because it doesn't say anything about RIM, it doesn't say anything about total resource cost test, it doesn't say anything about participant cost test.
Thank you. if Georgia Power is asking for a DSM budget of approximately $53 million for 2020, and let's assume that the company is going to spend the full budget and achieves a net benefit of 6.1. If that happens, Georgia Power will likely exceed the 120% threshold and would earn the 5 cent per kilowatt hour additional sum for those additional kilowatt hours. Is that correct?
What I would say is anytime we are beyond that 120% of goal threshold, the way we're proposing in this additional sum methodology, we would earn 5 cents over and above the 120% kilowatt hours, as we talked about in our filing.
Okay. But let's refer just briefly to SACE Exhibit 1, the Nexent report. If based on the Nexent report finding that the net benefit ratio was 6.1, isn't that a pretty good indicator that the company is going to easily exceed the 120% threshold for
Not necessarily.
DSM?
The way we're proposing our additional sum calculation is all based on kilowatt hour targets and how you achieve those targets. It has nothing to do with net benefits. So that 120% that we're referring to is over and above kilowatt hours that we would have targeted for our programs.
But if Georgia Power does invest, if Georgia Power does invest in the DSM programs, energy efficient programs, and based on the prior results from the 2017 Nexent report, isn't it likely that they're going to achieve or receive the 5 cents benefit?
I think she's already answered that question, Mr. Baker, when she said is the target and what they're doing, and I think she answered that question.
It has nothing to do with the numbers on this piece of paper is all I can say.
All right. Would you agree with the general statement that regardless of whether a profit is earned from building a power plant or helping customers avoid energy waste, the profit should be earned only when the investment is prudent?
I mean, you're asking me questions way beyond my testimony.
Yeah, just could you, does anybody on the panel know what the company's current return on equity is?
No.
All right. Nobody. All right, referring to, in the Georgia Code, dealing with the IRP, it states that when setting, referring to the Georgia Code at section 46-3A-9 regarding the IRP statute, it says that when setting the additional sum, quote, the commission shall consider lost revenues, if any, changed risk, and an equitable sharing of benefits between the utility and its retail customers, close quote. Can you identify any place in your pre-file testimony or DSM application where you discuss lost revenues related to DSM programs?
The lost revenue associated with the DSM programs would be embedded in the rate impact measure calculations.
Okay. Can you identify for me any place in your pre-file testimony or DSM application where you discuss changed risk related to DSM programs?
I do not discuss change in risk split to DSM in my testimony.
And you don't, you don't think there's any other discussion anywhere else in the application, to your knowledge?
I can't, not to my knowledge at this
Okay.
point in time.
Can you identify any place in your pre-file testimony or DSM application where you discuss an equitable sharing of benefits between the utility and its retail customers related to the DSM programs?
There's no explicit discussion in my testimony of equitable sharings.
Okay. And isn't it true that you're proposing to collect the proposed additional sum based on annual or incremental savings?
That's correct.
All right, I am going to present to you, I'm going to refer to your program planner summary in your DSM application. I'll provide that to you, and specifically the incremental and cumulative impacts tables, which are Appendix D1 and D2. Let me get those for you. Could I ask the court reporter to mark this as SACE Exhibit 3, please? I'm going to try to keep this as simple as possible and just refer to the proposed residential programs, the RES behavioral, and the HEIP programs.
Okay.
Okay, looking at the 2020, incremental savings for both programs, aren't they exactly matching the cumulative savings? And could you please explain why this is?
So let me see, residential HEIP, we're looking at incremental energy savings. And which one was the other one?
The RES behavioral,
Residential behavioral.
residential behavioral, and HEIP programs. Those are the two.
And you're asking me,
If you look at the 2020 incremental savings for both programs, don't they match exactly for cumulative savings? And could you explain why that is?
I have to look into this. I can't answer this question right now.
Okay, but would you agree that looking at the cumulative and the incremental charts, that both the RES and HEIP results are exactly the same?
When you took an HEIP, for the residential behavioral, the life of the measure is only 1 year. So I wouldn't expect that to accumulate over time.
I was just asking for the comparison of the year 2020.
Okay, so if you look at year 2020, you wouldn't expect accumulation of those kilowatt hours from year. Wait, I'm sorry. Ask your question again. I thought you were talking about cumulative.
Okay. Looking at the incremental savings for both programs, don't they exactly match the cumulative savings
For year 2020?
for year 2020? That's it.
Well, we didn't have time to accumulate in the year 2020. That's the first year. It should all match.
Okay, so why do they match? Is it because the project?
Because it's year number 1
Okay.
of these programs, and they have the same starting point.
Okay. All right. Now looking at year 2021, there's still a match for the behavioral program, but the cumulative impacts for the HEIP program are now double the incremental impact. Could you explain why these are different?
Yes, as I said earlier, residential behavioral program is a 1-year life program. So we assume that the savings are available only for 1 year. So it does not accumulate year after year like the other programs that contain the mix of different measures with different lives that provide benefits more than 1 year.
Okay, thank you. And if you look at the year 2029, can you compare and explain the same figures but for the year 2029 for the residential behavioral and HEIP programs?
So behavioral will be constant all the way through because of what I said. It's a 1 year life, so it will stay constant throughout this period. And let's look at HEIP. So that's the annual. And that HEIP should accumulate over time, and it is. And the reason is because it has measures that last for more than 1 year in it. It in fact has measures that might last 20, 25 years.
Okay. So turning to the additional sum, if you help save a kilowatt hour in 2020, but Georgia Power would get the same 4 cents regardless of whether the savings last 1 year or 10 years. Is that correct?
We would only get the additional sum for the first year of savings. We would not get the additional sum for second and third and fourth year of savings for that particular group of participation.
Thank you very much for your response. All right, I'm going to hand you a SACE exhibit number 4, please, if you would take a look at it. And this is a composite exhibit based on the 2 charts contained in SACE Exhibit 3.
Okay.
All right. Don't want to rush you, but can you just take a look at those figures and just verify the data?
Okay. For 2020 only. And so I see that incremental savings isn't the exhibit that you just provided. So
No, it isn't. It's a calculation based on the incremental energy savings on megawatt hours divided by the program cost.
What I was about to say was I can see the megawatt hour numbers in this exhibit you provided, cumulative and annual, but the program cost numbers is not in the exhibit.
No, no, it isn't.
Okay.
No, it
Okay,
isn't.
just making sure of that.
No, no. Let me ask a question, see if you can answer it. So with the same budget dollar, Georgia Power can achieve more than 4 times the incremental energy savings, it appears, with the behavioral program than with the HEIP program. Is that correct?
So if you just look at program cost, and I need to confirm these numbers because program cost is not on in your exhibit, and divided by megawatt hours, yes, you do have different ratios.
Do those ratios look reasonable?
Like I said, I need to confirm the program cost numbers and what they represent.
All right. Subject to check. Let me just ask you this. Subject to check, if those numbers, those calculations were correct, wouldn't that mean that the additional sum payment would be more than 4 times higher for the HEIP program?
So again, the additional sum that we're proposing has nothing to do with costs and benefits at this point in time. It is only 4 cents per kilowatt hour collected on gross verified savings. So it would be 4 cents applied to the megawatt hour or kilowatt hour numbers that you have here, and not program cost is not a consideration.
Okay.
I think we're maybe thinking about the old methodology
Okay, thank you.
or the current methodology.
All right, thank you. Let me shift gears here a little bit. Why are the additional sum amounts and methods different from the DSM program compared to the renewable energy PPAs? Why are there two different?
They are different programs and they provide benefit in different manners. Maybe some of my panel members can speak to the renewables.
Yeah, the renewable additional sum is
Additional sum.
is a percentage of the total net benefits when you're comparing the bids to the projected avoided cost. I think it's similar to DSM, but they are by nature different, and so the methodologies are different.
Can you identify any place in your pre-file testimony or the IRP where you discuss lost revenues related to the renewable energy PPAs?
But we don't speak specifically to that.
Is there any place in your pre-file testimony or IRP where you discuss change risk related to the renewable energy PPAs?
I don't believe it's in the main filing or testimony, but we've talked about it here, and the risk of projecting, assigning fixed cost contracts over 30 years based on their projections to avoided costs. So we've talked about that risks here in the last 2 days.
And I would just add that the RCB identifies risks of the addition of intermittent resources as well.
Is there any place? Okay, you said we've generally mentioned change risks. Are those risks related in any way to the calculation of the additional sum?
They are, in terms of the risk being that you're assigning a fixed cost contract price on a non-dispatchable resource based on its value beneath your projected avoided cost. And so that cushion or that difference between those is what you're seeking to get, and the additional sum is based on that.
Including the risk inherent in the renewable cost benefit framework that Mr. Bush was just speaking about.
Okay. And is there any place in your pre-file testimony, IRP, where you discuss an equitable sharing of benefits between the utility and retail customers related to renewable energy PPAs?
Where we request the additional sum based upon that, and we've talked about here in the last 2 days that is the goal of adding resources for the renewable projects without a capacity need, is to get those projected additional savings for customers, and it's those projected savings that we're talking about sharing.
Okay. And how will the sharing of benefits work in the context of the CRSP program?
The same way it has in the past. Again, it's the percentage of the projected net benefits levelized over the terms of those contracts.
Okay. And if the CRSP participant is going to avoid fuel costs and pay for the renewable energy, aren't the benefits of CRSP being reserved only for the CRSP participants?
They aren't. We talked about it yesterday. The direct fuel savings are, but in general, there's two ways that it benefits all retail customers. Number one is by adding those resources, the overall pool dispatch cost is lower. And then, as we've talked about from a risk standpoint, all customers are going to benefit for the full 30 years of that PPA, and the subscription term is covering the portion of that contract that's at least projected to promote savings. And so that's how it benefits all customers.
Are the contracts for the CRSP participants, how long are the contracts for the CRSP participants?
Well, that'll have to be determined. It'll depend on who notices in and how long they want to do it. I believe on the CNI program, they're anywhere from 5 to 10 years.
Now,
for the subscription agreements for that part of it.
Could they be renewed after 5 or 10 years?
I don't know what the tariff. I'm not familiar enough with the tariff to know if they can be renewed. So I don't know that.
But that solar resource would be okay. All right. Is it likely that a participant would want to extend the contract period for more than 5 or 10 years if they're getting this exceptional benefit from the product?
I can't speak for the subscribers. I know that initial term was based on what the initial participants in the CNI program felt that they needed or could sign. So I can't speak to exactly what they would do after the initial term, especially not knowing who the participants are going to be yet.
Let me ask you, how is a 10-year CNI better than a 25 or 30 Twiggs County project that's, you know, has a much longer contract on it?
Well, Commissioner, under this program in the CNI, the PPAs that Georgia Power executes with the facility will be 25 to 30 years out of the solicitation.
It's just the
The
subscription is
term
10 years.
different.
Okay.
That's correct.
Thanks.
Yes.
But you don't know if a participant could renew that subscription term.
I'm just not familiar enough with that provision. I'm not saying they can or cannot. I just didn't study up on that portion of it. Sorry.
Now, will the non-participating customers, when are the rates that a non-participating customer pay? I mean, they're going to be higher than what the CRSP participant is going to be paying, correct?
When you say the rates, I would disagree with that. The customer, the Georgia Power is going to execute the PPA and make the payments to the successful bidders in the procurement. And during that initial subscription term, the subscribing participant would cover that payment. And so it's a levelized payment that way. So it's going to depend, but the customers will be paying for the remaining term of that. And it's levelized or escalating, depends on the contract. But again, the benefit to the entire participant class, the entire customer base is, again, you're levelizing, you're accepting bids either on a levelized or escalating basis, and with projected increasing avoided costs, there's more net benefit at the latter part of those contracts than the initial part. By levelizing that and basing the crisp payment and tariff on the levelized portion, you're making sure that the projected net benefit at the end is more available for the entire retail class.
Now let's quickly turn back to the DSM programs just one more time for a couple of quick questions on that. If all customers are benefiting from avoiding the cost of constructing a new generation plant, is that correct? If you don't have to build a new plant, everybody benefits from that additional cost?
It's not only that's the capacity benefit, but also we're running our system less, so there's the avoided energy cost as well.
And industrial customers don't help fund the DSM programs today, is that correct?
That's correct.
And isn't it true that they would eventually benefit from avoiding the cost of, when an industrial customers benefit eventually from avoiding the cost of having to build new generation?
I mean, we believe that industrial customers are sophisticated enough to implement energy efficiency programs, and they're actually implementing those. They compete globally, and some with very thin margins. So we believe that they have incentives to implement EE programs. And not only that, they compete at a global level. So a mandatory DSM program would potentially result in some of the industrial customers subsidizing their competitors. So they came before this commission and made their case, and commission is in agreement, and we do not include industrial customers in the DSM programs.
Thank you. I'd like to clarify what resources were considered in the expansion planning model. In the IRP on page B-109, there are 3 resources listed: combustion turbine, combined cycle, and solar PV plants. But in the resource mix study table, page 4, on table 4 on page 12, only the two combined cycle and 2 combustion turbine technology options are listed. Can you please clarify whether your expansion plan only studied gas or studied gas and solar power?
So again, you're comparing table B4 on page B109. Was that your first reference?
Yes, sir.
And then you're comparing it to table 4 of the mixed study on page 12.
Table
Is that-
4 on mixed, yes, on the mixed study, yes,
All right. All right, good. Can you please repeat your question, please?
will do. Could you please clarify whether your expansion plan only studied gas or studied gas and solar power?
So our expansion plan actually includes the study that our expansion plan comes from includes all of our planned and committed resources. So it's got all of our nuclear, all of our hydro, all of that. So these are in particular candidate units for selection for the generic expansion plan. So are you asking specifically about which ones were offered as generic candidate resources?
Which ones were studied? Were all 3 of these studied in the expansion plan, or just the gas and were all? Let me ask you. In the expansion plan study, were CT conventional, CC advanced, and solar PV studied?
Solar PV was not a unit that was selectable in the generic resource expansion plan.
So it was not studied.
It was studied through the technology screening process, and it was all the way through. There's the description on page 12 speaks about the bus bar analysis, which is the final screening process, which narrowed it down to just these 2 units, these two resource types.
And as Mr. Weather said, it actually is included in our existing resources. So the mix includes all existing resources, which includes hydro, as well as expansion.
Okay. Well, I was just focusing on these right now. And was gas and solar power studied together by any chance as a combination?
In the expansion planning model?
Yes, sir.
They were not. We talked about that earlier today when Sierra Club was asking some questions about the combined cycle and the combustion turbine were the ones that were offered in the expansion planning model.
Yeah.
And it's discussed on page 421 in the main as well.
And just further clarify, as Mr. Grubb is saying, so new solar units are included in our existing planned and committed units for the operating companies in our integrated resource planning process. So the IRP produces a generic repeatable expansion plan based on the least cost units to serve our capacity needs, and that produces what we get as a set of avoided costs for the benchmark plan. Those avoided costs are used to compare and evaluate the value and the cost of renewables, as well as Dr. Smith is speaking about the DSM programs and other evaluations as well, thinking about unit retirement studies, other things like that.
All right. Did the expansion plan look at wind, storage, coal, or nuclear?
Those are not in the expansion plan, no.
Okay.
So our expansion plan consists of the combined cycle and combustion turbine resources. So to the extent those are existing or planned resources, those are in our case.
All right. And did the expansion plan also include the high carbon cost scenarios too?
We have scenarios that include the $10 and $20 carbon cases. So those are also filed in the study.
Okay, thank you. Do you know what the model? Can you estimate for the gas turbines selected by the models? Can you estimate their modeled annual capacity factor?
Not sitting right here, no. And I don't think we've filed that information.
All right. Does the company consider storage a dispatchable resource?
Mr. Bushman, want to speak to that?
Generally, we consider storage as being a dispatchable resource. We don't have any storage like lithium ion. Obviously, we have pump storage hydro today, and so we do in fact use it as a storage resource, and it's dispatchable. And we would, in our view, of, particularly for the 50 megawatt early deployment request, we would expect it to be a dispatchable resource as well.
Okay. And doesn't a dispatchable resource provide firm capacity?
Yes, in general, yeah. We've covered on the battery energy storage systems that we're proposing. Mr. Bush had a lot about this yesterday. Is we've got to learn exactly all the different use cases for that to determine what that firmness is for battery, because it is limited. And there's also what makes the battery unique is you've got to charge it, right? So there's a whole other aspect of it that other resources don't have.
That's right. So the fact that you do have to charge, take the time to charge the battery limits the firmness of the battery.
Thank you. Could the strategist model optimize for capacity and energy storage additions based on the mix of projects provided for to select?
Could you say that one more time? I was trying to catch the last part.
Sure. Could the strategist model optimize for capacity and energy storage additions based on the mix of projects provided for it to select?
You're talking about in the case, our reference case?
Yes, sir.
Well, we didn't have, energy storage did not make it through the screening criteria to be a selectable resource, so it wouldn't have selected it for this generic repeatable expansion plan.
Okay. At page 421 of the RP application, you state, quote, intermittent resources such as solar and wind were not included as selectable technologies for the expansion planning model, but instead were reflected in the model as planned and committed resources. Close quote. Does this statement mean you modeled the renewables as if they were already on the system?
So this is the reference I was making to your prior question where we describe how we did the technology screening. And so what we've done in the model is we do model planned and committed resources for solar. So the 1,000 megawatts that we're recommending in this case are modeled in that unit.
And just to clarify, you said modeled as on the system, so as of today they're not, but the timing of the programs when they come in, they're modeled as coming in at that time.
Were the price assumptions for renewables, their price assumptions for the renewables if you incorporated them in the model?
No, not for those. What we're looking at on the expansion plan model is the incremental cost and how you would build the rest of the fleet out. So what we do is we show those resources being available. The model's not trying to determine those resources, it's trying to determine what we would build. And so you're putting in the energy profile from those, but not cost.
Were there also energy assumptions for each renewable and transmission cost assumption?
When you say transmission cost, that help me there on what your question is specific to that.
Transmission costs is referring to construction of new transmission to service a generation resource.
Not in the expansion plan. It is a generation expansion plan, so it doesn't model transmission other than the candidate units that we offer do have an assumed cost to build interconnection to the transmission system, but it's not solving any transmission constraints or service issues. That's an entirely different process.
Okay. Were there capacity assumptions in the expansion planning model for renewables?
Yes. So all the renewables have capacity benefits in the model, if that's what you're asking about. They get
yes, sir.
capacity credit according to our capacity equivalence methodology.
I was just asking for capacity assumptions. Were capacity assumptions incorporated in the expansion planning model?
If that didn't answer, I'm not sure if I understand what your question. What do you mean by capacity assumptions?
Did you use a figure for when you ran the model for renewables? Did you include a capacity assumption for
Are you
a
asking
renewable?
how much, what's the capacity amount of renewables that we include?
I'm just asking if you include, I don't need the specific number, I just was asking if you include a capacity assumption.
Yes, certainly. We include all of our existing renewables as well as our planned and committed resources in our case.
And commissioners, when we do that, what we do is we have a profile for each of the unique resources that we have on the system. And each has a unique ICE factor, as we've talked about, in terms of its profile and also when it's come into the system. And so when we model those, we're doing both the energy profile and how it would contribute to meeting the peak.
Okay, thank you. Thank you very much. Referencing on page 109 of the RP main document, table B1 there. No, not table B1, table B4. Was solar given a capacity value?
Let's get there.
Your
Page
table
109.
table B4 again.
Before.
And when you asked if it was given a capacity value, you mean when we were screening it?
Yes, sir.
Determine that? Yes, it would have been. I'll let Mr. Weathers or Mr. Bush add to that, but yes, we would have had a capacity equivalence factor that we would have been looking at.
Thank you.
In the screening process, is that what you're asking about?
Yes, sir.
Uh, Well, this particular table refers to the secondary screening process, which I'll let Mr. Bush comment about this particular screening process that you're referring to. But I don't think that there's capacity equivalence provided in this screen.
That's in this particular screen. Mr. Grubman been talking about different models, but our initial this secondary screen, we do several screens looking at a broad range of different technologies, and as we screen those technologies based on various conditions, environmental conditions, based on geographically, are they appropriate for us, environmental impacts, things like that, we consider those, and then we get down to where we say, here's a list of technologies that we want to add further screening, and we do a levelized cost of energy screen. And so what that is looking at the expected life cycle costs for capital, for the fuel of the resource, or O&M of the resource, and say, these are the types of resources that we think look economic for us going forward, and we'll pass on an LCOE basis. Now that actually doesn't look at the capacity value, it doesn't consider dispatchability, it doesn't consider a range of capacity factors. It only looks at an LCOE number. And then we pass that information to Mr. Weathers, and then he'll look at it, and he can explain how he takes that information and then uses it to determine what resource is a candidate resource to be used in the expansion planning process.
That's right. In that subsequent screen, which is more of a bus bar screen, again, we're looking at candidate units to fill our capacity needs. So we do apply a capacity equivalence there to make sure we're looking at things on an apples-to-apples basis for one capacity versus another capacity.
Thank you. Thank you very much. Referring back to your conversation yesterday with Mr. Stair, will the company when the company conducts a solicitation for capacity, and then it will use its capacity expansion model to select which bids result in the portfolio that minimizes net present value of revenue requirements? Is that a correct summary of the process?
Yes, you're talking about for a capacity solicitation?
Yes, sir.
Yes, I think that's it.
Thank you.
Summarizes it.
Will there be any difficulty with the capacity expansion model considering technologies like wind, solar, and storage, given their capacity values, and then selecting those resources to fill a part of the capacity need?
No, not at all. In fact, we're able to, in our expansion plan model, in our capacity model strategies, as mentioned before, we do have solar and wind in there. We do have storage. Mr. Bush mentioned pump storage hydro. It's able to properly model those in our system in the way that we would model them when we're evaluating bids for capacity RFP.
Thank you. And will you be evaluating each bid singularly, or will the bids be included in the capacity planning model as options to be selected?
So again, you're talking about for a capacity RFP, we're comparing one bid against another. So it's a competitive solicitation. So we're looking at each bid, the product that was bid in, the cost of that, the benefits of that. So we're comparing one against another. We're not using a model to generically select something. We're comparing the bids that we received.
Was the capacity expansion model constrained by being locked down regarding the resource types and technologies the model could select to meet system load in the aggregate, or did it have the full range of technologies available, including solar, wind, and storage?
Again, Mr. Bush spoke about the technology selection process that we do. So we don't offer every single technology there is to the model. That would be, the model wouldn't be able to run if we did that. But there's a screening process to get down to select the most economic resources that you need for for whether it's you need primarily more energy, or if you need peaking resources. Those are the models that were selected and offered to the strategist model. But also, as we talked about, I think I talked about yesterday, what you're producing is a generic expansion plan. It's a generic roadmap for the future. It's not indicative of decisions that will be made. So decisions to add capacity will be made when the capacity needs identified, and it will be through a competitive process according to this commission's RFP rules and presented to the commission for certification.
But would solar, wind, and storage be some of the technologies that would be evaluated in the capacity expansion model?
If we received those bids, and you're speaking to the competitive solicitation again for capacity?
Correct.
Yes, in that process, we would model the bids that we receive, and of course, we'll go through the RFP process and work with staff and independent evaluator, and all of those modeling assumptions and the way we're doing that competitive solicitation and evaluating it will be agreed to and structured for that specific solicitation.
Okay. Thank you for that response. Was the replacement cost or equivalent annual cost method employed in the strategist model to replace expiring PPA contracts during the resource planning period?
Say that one more time, please.
Okay. Was the replacement cost or equivalent annual cost method employed in the strategist model to replace expiring PPA contracts during the resource planning period?
I don't. Those you use two different methodologies. I don't think that I'm familiar with how those are defined.
Yeah, I'm not sure what the equivalent cost methodology is. What we do in the expansion plan is we do not assume the continuation of PPAs that we have at this time. So they will actually end, and then that will result in a capacity need. And then what we've talked about on offering units in the expansion plan, it would then need to build more, and the model evaluates if it should be a combined cycle or combustion turbine.
And the model will show that as a generic expansion plan. Again, how those needs are filled, it could be a purchase, it could be a self-fill. That will be determined at the time that the need is identified, and then the selection process occurs.
Okay. Do you know when the company plans to issue the RFP for 2026, 2028?
Yeah, we would look to issue the RFP as soon as we could after the IRP is complete. We obviously have to work with staff and the commission on that, but there are a lot of reasons where we would want to move forward that as soon as we could.
All right. Do you anticipate that the projects associated with expiring PPAs referenced at page 40, line 11 of your pre-file testimony will bid into the RFP?
You said page 40?
Yes, sir. Page 40, line 11.
Yeah, I'll let Mr. Grubb comment if he thinks differently. I don't think we know who will bid into the RFP. We're just commenting that there are PPAs the company has that are expiring, and that's reflected in the needs that we have. And so whether or not the owners of these, the sellers of these PPAs will bid in, we don't have that knowledge.
That's exactly right.
And didn't the company just issue the 2020, 2021 ready RFP in December of 2018?
I believe the second part of that was submitted, yes. It's in that process right now.
Right. And based on the company's experience with ASI and ready programs, wouldn't it make sense to issue the 2026, 2028 RFP after the 2022, 2023 projects are complete?
You're talking about so you asked about renewables, but now you're asking about the capacity.
No, I'm not saying. I'm talking about the bidding for the RFPs.
So the capacity-based RFPs that we're requesting?
Yes.
So the 2022 and the 2023 RFP and the 26 and 28 RFP we feel should go out at the same time for two reasons. One, we feel like there's a lot of reason to move as fast as we can on the 2022 and 23 in terms of making sure we have those options if we recommend to retire Bowen 1 and 2. And then the other is when we're looking at the 26 to 28 time frame, making sure we have enough time to accommodate new construction, whether it be company bid or market participant bid. So there's timing that we feel we move as fast as you can and give everybody time to deploy a new build if that's in the best interest of customers before our capacity need.
But I mean, hasn't history shown that prices have continued to trend downward in over time?
Well, these are capacity-based RFPs, so they can be combined cycles and combustion turbines, and I know we've talked about in terms of solar, there's that expectation that new solar prices are decreasing, but I can't speak to how market participants would bid in the assets that they have in existence now. So we don't know and can't predict on what that might matter to the market, but we feel like there's a need to move forward with both as soon as we can.
And getting those RFPs for the 2026, 2028, getting those bids for the 2026, 2028 RFP, would those be helpful in delaying the decision to see if prices or if there's any kind of benefit associated with waiting a little while before making a final decision?
Which prices are you referring to that might change?
I guess it would be the fixed prices for the combined cycle or CT or any of the resources that might be bid in.
Yeah, we're not looking at timing the RFP on predicting what the market may do. Go out is when we need to in terms of meeting our needs to make sure we've got the options for making the best decision for customers. So that's what we're basing the schedules on. Okay. And also there's the it makes sense to do these RFPs and target coming back in the 2022 IRP with all the information we need to make decisions going forward. So having them completed by then is another driver.
Thank you. Could the company look at some long-term solicitations and recommend them to the Commission outside the RFP capacity goal if they offered an extraordinary advantage like the wind PPAs?
I mean, there is the rules do allow that. I'm not sure of any particular situations that may happen, but if something did come along, we would determine if it was in the best interest of customers. We could bring it forward, but we don't know of any of those right now. But I think that's always been an option that the rules allow for us to, if there's such an opportunity comes along, to recommend it to the Commission.
So there's no need to know if Bowen's returning before issuing the 2022, or before issuing either RFP. It's going to be done regardless of whether Plant Bowen in the future is determined to be retired.
As we've recommended in this IRP, we're recommending moving forward with an RFP, but we have not made a decision on Bowen 1 and 2. There is no indication that we need to retire it right now. What we're looking for is that option that if we get to the next IRP and that is in the best interest of customers and we recommend it, we need to have an option. So what we'll be doing is looking at what we have from the RFP and then also look at the unit retirement studies for Bowen and make that decision.
Thank you. Could the Commission approve the company's request for the CRSP program and authorize the company to develop an additional 1,000 or 2,000 megawatts depending upon whether there is demand for renewable resources that exceed the current projected amount of 950 megawatts?
Yes, the Commission can do that.
I agree.
Next question, please, quickly.
Well, you just got rid of 3 or 4 questions there.
I like that word retirement a while ago. It sounded pretty good to me.
I'm sorry. I'm sorry, Commissioners. I know this is a little dry, but I asked 5 subject matter experts if they had a few questions they wanted me to ask for them.
Go ahead, Mr. Baker.
This is what happened.
While you look, Mr. Baker, I have a question for the panel. So, within the filing, there's estimates placed upon the 2 types of coal that are burned, as well as the natural gas sort of, pricing forecast into the future.
Mm-hmm.
Do you do the same thing on solar parts and and if so, where is that, and can you speak to that at all?
I'll be glad to talk about that, Commissioner. We do actually have a forecast of solar prices going forward in the future, and we've seen them decline through time, and we have an assumption in our view of the world going forward of what solar costs will be per kW in the future. It changes very rapidly, and we see efficiency in the panels continue to increase, but we do have prices actually decreasing for solar in the future.
Thank you. Did I give you enough time, Bobby?
Yes, ma'am.
Okay.
Appreciate it. little breathing room. How many qualified facilities are selling renewable energy to Georgia Power today, if you know?
I mean, there's many. There's several of them. We have several on energy only, and then we've got a lot under the proxy QF contract, 350 megawatts or so. I can't remember exact count, but there's lots of them. And then you also, qualifying facilities are also the facilities that have bid in on the renewable solicitation. So we have quite a lot of QFs.
Is there any practical limit to the number or capacity of solar projects that can be integrated into the Georgia Power Company system within a given year?
I mean, yes, in terms of the number of work people that can actually implement those projects and how fast they can be developed. That's one limitation, and then the other is just, is it the right thing to do? So, both of those are limiting factors.
Okay, on Monday afternoon you were asked about the impact of DG Solar on electric service to agricultural customers. And Mr. Grubb, I believe you agreed that DG Solar would help reduce distribution losses, but could you explain that distribution losses are considered, how distribution losses are considered in the RCB framework?
I'll let Mr. Bush answer that as it's a framework question.
Certainly, I'll be glad to talk about that just a little bit. What we do in the RCB framework, again, is try to identify all of the costs and all of the benefits associated with implementing the new resource on into our fleet. And we recognize that distributed resources are unique in the sense that they can be much smaller and they can be put at places where larger utility scales cannot. And that means they can actually go onto our distribution system. And so the closer you put a resource to our load, you actually eliminate some of the losses. If I have a generator that's on the transmission system and it has to transmit through the transmission system, through the distribution system to our load, there'll be more losses generated from that facility than if I put a generator closer to the load. And so what we've done in the RCB is recognize that, assume those distributed resources are closer to the load, and then giving them credit for reducing, on average, the load required by the rest of our system to serve the load there on the distribution system.
Are there ever instances where those distributed resources might keep you from having to spend extra money on the grid or the circuit there, substation, other equipment? Is that something you would ever take into consideration?
Well, Commissioner, yes, sir. We take that into consideration. But when we look at the study for solar DG, for example, we look at it and make sure that we recognize that it can't be there 100% of the time, and that we're required to serve our load 100% of the time. So the credit that we do give it, which not only do we give it loss credit, but we also give transmission deferral credit for distributed resources. But we don't give it distribution deferral credit, because we continue to build out those wires that are going to be there 100% of the time. In case that unit's not available, that resource is not available, so that we can serve our load.
It's a practical matter, the same way that the young man from the forestry industry yesterday said, you know, if we were closer to the mill, we could cut our transportation costs, and the product would be worth more. And same thing with transferring electricity from point A to point B.
That's right.
And isn't it true that the RCB framework considers distribution losses based on average distribution losses?
That's right. We look at average on a voltage level for the system. That's correct. And look at the losses at that voltage level, and that's how we calculate. We do distribute them on an hourly basis, so that we can actually have the profile that we're evaluating's impact on an hourly basis to those losses. So we do have an hourly view of those losses, but it is based on the average at that voltage level. That's correct.
Thank you. So might it be the case that distribution loss savings associated with DG Solar on agricultural properties might be significantly higher than average and benefit that would not be captured in the RCB framework at this time?
So can you just repeat your question?
Sure. So could it be the case that distribution loss savings associated with DG Solar on agricultural properties might be significantly higher than average, a benefit that would not be captured in the RCB framework at this time.
It is true that it could be higher than average, but it's also true that it could be lower than average. So our process is a very robust, it's technically sound, and it's comprehensive and approved by the commission. We feel like it's the appropriate approach when evaluating those type of resources.
Thank you. Will all 50 megawatts of the battery energy storage systems be in Georgia?
Yes.
And does Southern Company have any projects using battery energy storage systems today?
Yeah, we have a few small projects on our system today. There's actually one located in Georgia that's a 1 megawatt, 2 megawatt hour that we have. That's an R&D project today, yes.
Just out of curiosity, where is that located?
It's located in, I don't think that's crazy.
Yeah,
That's
Cedartown.
Cedartown, Georgia.
Okay. And how long has that been being tested, I guess?
I believe it went in service in 2016, if I remember correctly. So it's been in service for a couple of years.
Thank you. Does the market differential adjustment change the market price of the wholesale resource to the levelized revenue requirement price?
Yeah, so we spoke about the MDA yesterday. What we are doing is we are recommending that those 25 megawatts back to retail service, where those costs go back into retail revenue requirements, and the MDA is an adjustment to that impact to customers. And so it is a negative MDA in this case, which would reduce revenue requirements to customers.
Okay. Will that be an increase on per kilowatt month dollar basis?
So it's not an increase. We've evaluated on a dollar per kilowatt, but it's a negative.
Thank you. And doesn't Georgia Power consider resilience issues and needs today in its planning?
We do. In many aspects of our business, what we were talking about in the IRP are just new considerations for resilience that we feel as planners and system operators we need to consider in terms of the changing of the fleet, and then also the increased risk of cyber and physical threats. So we absolutely do resilience measures. This is just other considerations and new threats and new changes to the system that we need to consider. But we aren't asking for any specific actions in this IRP. We're just noticing the commission that those are things we think about, will continue to consider.
So at page 57, you mentioned other potential long duration, high impact events. Was that what you? What do you mean by other potential long duration, high impact events?
So we've talked about in the main filing things such as cyber security threats or physical attacks or pipeline disruptions as far as an act, and so it's things of those nature.
Okay. And approximately how much is the net book value of the generation facilities the company is asking to retire?
We provided that in a data request. So there's, and I think the net book values, we talked about them yesterday too. Let me find them real quick. So I know the hydro facilities are quite low. They're in the thousands, I believe. Plant Hammond 1 through 4 is around 500 million on net book value there. Macintosh is around 39 million, and then the hydros are just like 16,000, 800,000, and 93,000.
Okay. And at page 59, could you explain why, quote, unusable material in supplies inventory, close quote, should be reclassified as a regulatory asset for recovery purposes?
I'm not a regulatory accounting, but the reason there is those are inventories and supplies that we have purchased at those facilities for the use of customers that should still, it's somewhat similar to the book value of the plant, and so it should be moved into a regulatory asset for recovery because we made those investments for customers to have them there for service at those plants. But it's the right decision for the recommending that retirement. So it would be similar to the net book values.
So if it's, I mean, if it's hypothetically, if it's an unusable spare part, it should be recovered at its purchase price that it was
I don't know what the, I don't know the value of it is. I don't know the value of that, but the point is that we had that part to be used at that plant if needed, and so it should be recovered.
Thank you all very much for your indulgence and help. I appreciate it. Thank you, commissioners, for your indulgence. That concludes my cross-examination, and I'd like to move cease exhibits, I believe, 1 through 4 into the record, please.
So record. Southern Renewable Energy.
Good afternoon, Commissioners panel. It's nice to be here today.
Tell
Bruce
the
Bur-
truth now.
Well, it's been a long day. I'm Bruce Burkett with the Southern Renewable Energy Association, and next to me is Simon Mahan, who's the Executive Director of the organization. I'm going to be asking some questions in, I believe, 5 different areas. And I don't think these are going to be too voluminous, so we'll move forward. So, hello panel. The first area I want to cover is the generation mix study, and I'm going to refer you to your testimony on page 38, line 14, just basically where you said not only are economic benefits to a diverse fuel supply, but there are also reliability benefits. And my question is how the company quantified fuel diversity value and reliability benefits of fuel diversity.
We don't quantify them. It's very difficult to put a number on fuel diversity. I think there's been a lot of industry efforts in the past that have struggled with that, but it's a qualitative consideration on both of those aspects.
And as a qualitative review, do you see there being some significant value in that without putting a specific number on it?
Yeah, we do qualitatively. It is something we consider. I mean, I think we mentioned it some yesterday. It depends on what the economic impact of that diversity is, right? But it is a factor to consider, and I know Commissioner Eccles mentioned it yesterday in the value of on-site fuel storage, which we've mentioned in the filing. So it's absolutely something that we look at when we make decisions.
Thank you. Georgia Power's IRP supplement analysis only evaluates 1,000 megawatts of solar and 1,000 megawatts of wind energy. However, all the relevant cost assumptions and output data are redacted. Is that correct?
You mentioned 1,000 megawatts of wind. What we've recommended. Oh, you're talking about the illustrative study. You're talking about in the framework study.
Yes.
Okay, I'm sorry. I thought you were talking about our recommendation. So.
Yeah.
Yes, you could restate the question again. I'm sorry.
Yeah, I mean the IRP supplement analysis only evaluates 1,000 megawatts of solar and 1,000 megawatts of wind energy. However, all the relevant cost assumptions and output data are redacted. Is that correct?
They are. It's trade secret.
Okay. Why did the company limit their analysis to 1 gigawatt when in the 2016 IRP the company evaluated up to 8 gigawatts of solar and 2 gigawatts of wind?
And so we spoke about this yesterday some when the framework was a new part of our planning process that we filed for approval in the 2016 IRP, and so we did an 1,000 megawatt tranches to just lead to a lot of the takeaways from the framework and the fact that the more renewables you add, it changes the value of the next one. In terms of since we've done that illustrative filing, when we updated it with the joint recommendation and we updated it here, we've done 1,000 megawatts, mainly in this situation because that's what we're recommending. But we also know, as I mentioned yesterday, that we're not quite to that level that the 1,000 megawatt tranches showed us when some of the other components come into fruition, but we are getting close.
Okay, I'm going to now change to the winter-summer reserve issue. Would a winter reserve margin affect transmission planning practices for the greater generator interconnection queue, and how?
So the generation interconnection queue?
Yes.
I don't believe it would. I mentioned some yesterday that on the transmission studies, the summer is still a constraining case for our transmission system. What we're looking at on seasonal planning is generation reliability risk. I think I mentioned that we don't study winter. We do study winter. We don't file it in the IRP because it's not a constraining case. However, the winter capacity in seasonal planning, the interconnection queue on transmission is going to be driven by summer cases, I would believe, and what the transmission system is seeing from that standpoint.
How does the reserve margin affect the renewable cost benefit framework, the RCB?
So the renewable cost benefit framework includes a number of different components, and those components are based on production cost studies, and those production cost studies, inherent in those production cost studies are assumptions about the way the reserve margin varies over time, and Mr. Bush can elaborate if he wants to, but is that the question you're asking?
I think so. Someone's going to elaborate on that.
I mean, if he wants to, I think that answers the question. We reflect the reserve margin that we have and expect on our system throughout time in the production cost analyses that are used to produce the values for several of the components in the renewable cost benefit framework.
And again, I'd just add that the models that we use are not just used in the RCB framework. They're used the output of the reserve margin impacts all of our models and all of our evaluations from DSM to unit retirement studies to the RCB.
Is the company required to develop a capacity-based reserve margin?
Yeah, I believe by order we turn over the reserve margin study as part of the IRP.
And isn't wind energy a winter peaking resource?
I would say generally from the profiles and from the information that we receive from most folks, in our renewables team, we get unsolicited offers from time to time. Most of those offers come from the Midwest. We don't generally have offers from within our footprint. And oftentimes we do see profiles that do produce more energy in the winter periods than in the summer period. So that's not unusual to actually find.
Are you aware that in the PJM region during the 2014 polar vortex, wind energy operated at high levels during critical peak periods, helping keep the system stable and saving customers millions of dollars as a result of their operational presence during the event? Are you aware of that?
I'm not familiar with the operation of wind in the PJM region.
Would you agree that a wind reserve margin would improve wind energy capacity value in the RCB? Would you agree with that?
So I'm going to jump in here, and they can help. I mean, the winter reserve margin again is not a direct driver of the RCB framework in terms of the evaluation of a profile or a resource. We've spoken around the capacity worth factor table, which does reflect higher winter reliability across the system, and so that's where we would capture the value if a wind resource did contribute more in a winter morning. Then the framework would capture that in terms of the capacity value that profile brings.
Yeah, and also I'll jump in here also. So the capacity worth factor table is an annual table. It includes both summer and winter values. It's always included those, even when we only had a summer target reserve margin. It includes annual values in the proposed under proposed seasonal planning as well. So what it does reveal though is that there is winter reliability risk. And to the extent we have winter reliability risk, we need a winter target reserve margin to address that risk, or else that risk much higher likelihood that risk will become reality. And one of those cold winter mornings, we won't have enough generation to serve all of our load.
And are you saying then that wind helps in that regard or doesn't help in that regard?
It would depend on the profile of the wind, but again, we've talked about our capacity work factor table, which show which hours of the year we have our high reliability risks, so such that a wind profile matches up with those risk hours, then it would show some more benefit there.
And-
Yeah, and of course have to look at the cost also. I mean, what's the most effective way to meet your winter reliability risk that you have? So and I think that will be determined in resource evaluations when you evaluate wind side by side, along with any other resources. If you have, say, for example, a renewable RFP or a capacity RFP, if that wind has some storage that enables it to provide firm capacity.
Okay. Where does the company expect to get its wind resources from?
Generally speaking, we would assume the Midwest region. We've received offers from that region, so probably on average that's where we get most of the offers from.
So MISO, you would say, or SPP, or
We've received offers from both those regions.
how about ERCOT?
We have spoken with folks that have resources in our pocket.
Okay, thanks. And having talked to those folks, do you know what the wind capacity factors are from those regions?
Well, again, it depends on the specific location, but generally those are relatively high capacity factors. 45%. We've had offers even greater than that from proposals of resources in those regions.
And would you say that the capacity factors in the winter from those regions are higher than the capacity factors in the summer?
I don't think I've actually broken it down and looked at winter versus summer. Again, I do know that the output that we see from their peak production is often more in the wintertime than in the summer, but I don't know that I've done a defined study. It doesn't seem unreasonable to assume that, though.
But if we've got the clause that you guys negotiated in the other deal, then we've got firm anyway, right? Regardless of
correct. That's
regardless
exactly
of their performance. So, do you see anything as good as that deal still out there, or did those all go away?
Well, I would say there's still folks that are offering things. The problem is not the wind itself. I think in this example, Midwest wind is a very good resource with a high capacity factor. The problem is getting that resource from that location reliably to us. Because when I have a generator in my footprint, I have to worry about how it's going to operate it, when it's going to operate it, and what its availability is. I have those same exact issues when it's in Texas or Oklahoma, but now I also have the wheel to get from Texas and Oklahoma to Louisiana and Mississippi all the way back to us. So the challenge oftentimes is the ability to acquire firm transmission and to get that firm delivery on a competitive basis. And I think Georgia's RFP allows that to happen. And so if there are opportunities for the customers of Georgia for that to be a better resource than the alternatives, you'll see that through the RFP.
So the 250, is that what we had in the Oklahoma wind, 250
Yes, sir.
megawatts? Have we had any bureaucratic issues relating to getting it here, any kind of extra fees that's been charged to us that we didn't account for, stuff that those regions, where they may have given us a hard time?
I'm not aware of any, but I'm also may not be aware of them because I don't deal with that every day.
Aren't
so I don't know.
our PPA contracts with some of those wind providers FOB destination?
Yes, sir.
They are.
So they have to deal with those
That's
issues.
exactly right.
We
They
don't.
deal with all those issues.
So you're saying the risk is on the developer in that case?
On the one providing the
Yes.
PBA service to us, yes.
Correct.
Okay. What were some of the issues the company faced during the polar vortex in Georgia? Some of the energy issues?
I mean, I'll let Mr. Weathers add on there, but I mean, with the low temperatures, I just know there was a higher load requirement than we initially thought going into those few days, and we did learn a lot about some of the exposure of some of our units. We'd had several years of mild winters, and so it was mainly unit outage impacts, and then just that load growth and that load demand from customers. Anything else to add, Jeff?
Yeah, I would agree with that. The extremely high loads were very impactful, and a lot of and those were very correlated to the very low temperatures. So we had system weighted temperatures around that time of 9, 10 degrees. So we experienced a lot of the same drivers that we have in our reserve margin study related to winter. You think about additional unplanned outages at some of our units. Certainly we saw the volatility in the loads. They were very high on that day. And then we have in our report, the numbers are trade secret, but we had significant reserves on the time of the system, and we needed every one of them. We needed every one of those reserves just to keep from the lights going out on that day, on January 7th of 2014. So, but that's why we're proposing a target reserve margin. So those things aren't unexpected. We're not, even with a winter reserve margin in our study, you don't plan to serve load on every possible instance. There's still unserved energy. But by planning to appropriately address winter reliability risk, you're ensuring that you're able to mitigate a lot more of those than you would if you just ignored that risk and continued to only plan for the summer.
Thank you. Didn't the company have natural gas pipeline issues during excessively cold weather and the polar vortex, and in trouble getting natural gas to your generating facilities or to customers?
I think consistent with what we have in the reserve barge study, to my knowledge, we're able to get all of our contracted gas, even extreme cold weather. I think that was probably the case during then. I don't know for sure if that was, but that would be my expectation, is that we contract for firm gas capacity on the pipelines. Those pipelines are sized to be able to deliver that to you. And so that's the delivery we get. Now when we talk about the natural gas limitations that we see in operations and they're related to cold temperatures, those are when the pipelines restrict you to only get your contracted amount. So I think we talked about yesterday, to the extent that when temperatures are really cold, you may need to run your combustion turbines longer than you contracted for, or there may be excess capacity the unit can deliver if it has the gas. But again, you don't plan for those very extremely cold temperatures in your weather normal cases, so you don't have access to that gas.
Yeah, and is there a priority if for some reason the company had less gas than it expected because of the cold weather or some other incident? Isn't there a priority that gas actually goes to heating customers as opposed to the generators? Is that something that's the company has as a policy or a rule?
But I think you're asking about the priority for the pipelines.
Yes.
And I'm not familiar with the specifics, but I do believe that they'll serve that load. But again, my understanding is the way that they build and construct their pipelines, and they charge people for firm capacity, and they build their pipelines out to reflect the firm capacity that they're charging people for. So they're typically able to deliver to us the firm capacity that we've contracted for our customers.
I'm not saying exactly that there is a specific problem here, but wouldn't you agree that over-reliance on a single resource like natural gas as a winter capacity resource has its own set of problems?
Well, I don't know how you would define over-reliance. We talked about the value of the diverse portfolio. We talked about natural gas is reflected in our expansion plan. It's reflected in our reserve margin setting, and to the extent that natural gas does have some limitations, one, we have a fuel policy that specifies how much firm transportation we provide, and if you have on-site backup fuel oil, then that helps mitigate some of that. If you don't, you also have gas storage that you're contracted for. And so to the extent that if natural gas is the most economic resource to add, all those things are already accounted for in the analysis that we do.
Okay. doesn't the renewable cost benefit framework, RCB, I guess, include renewable energy capacity as a benefit? Or does it? I guess not, does it?
Yes.
It does, okay. And would you agree that renewable energy can provide capacity even without energy storage?
Yes. Yes, we give renewable energy the capacity credit provides, is correct.
Thank you. Did Georgia Power study combining wind and solar resources to improve winter and summer reliability?
Yeah, and let me just make sure I'm clear about that. We provide the capacity provides, but it's not the nameplate capacity. We use a capacity equivalence methodology to look at the actual value it provides in the hours where there's reliability risk throughout the year. Yeah. So can you please repeat your question one more time?
Oh, you want to hear it again? Okay. Does Georgia Power study combining wind and solar resources to improve winter and summer reliability? Do you study?
Not as part of any of our normal planning processes. I don't know if we've gotten any bids in that way in any of our solicitations. If we did, we would be able to evaluate what that combined profile looks like. But in terms of our own study, we did not.
But it's something you consider as potentially capacity.
If someone bid that resource mix in, then we would be able to evaluate that on our system with the RCB and what that profile was.
Thank you. Does Georgia Power's current wind and solar PPAs have a capacity component?
In
Yes.
terms of yes, in terms of the contribution to planning or payment.
Yeah, that's right.
Both.
Both. So we've mentioned that when we model solar or wind contracts, we do reflect both the energy profile and its contribution to the peak, so that capacity value. In terms of pricing, we evaluate that, but I believe all the pricing structure is on an energy basis.
Thank you. For existing energy-only PPAs, would these facilities be allowed to bid capacity into the capacity RFP?
The capacity is when you say existing. Could you ask again one more time? Existing facilities.
Yeah, it's ones that you already have on your system.
So energy only qualifying facilities. You're talking about the capacity RFPs, not the renewable
Yes,
RFPs.
exactly.
If they're already under contract to us, they can't.
If it were an energy-only PERPA contract, I guess they possibly could because there's not a binding term on that, I believe. But it would depend on what the firmness of that contract is. But Jeff's right. If it's an existing combustion turbine or combined cycle that's under contract, then that obviously could not.
I'm going to move on to the customer renewable supply procurement program.
Okay.
And just note that the first RFP will be issued for 250 megawatts and 450 megawatts, and the second RFP would be for at least 250 megawatts, plus whatever is rolled forward from the first. Is that correct?
That's correct.
Okay. Will the 450 megawatt procurement for new customers be selected based on commercial and industrial customers providing a notice of interest?
That's correct.
Okay. And why should there be a differentiation between new and old C&I customers?
We've spoken about this in terms of the intent. We're basing this on the success of the commercial and industrial program, and we're looking at. We've had a lot of existing customers express an interest in being able to subscribe to these types of programs, and also a lot of new customers that are looking to relocate to the state. So it's just an opportunity to accommodate both of those customer classes seeking such an opportunity.
And something that's kind of very curious, I think. Why should a new customer be so large when they could theoretically apply as an existing customer after a year's worth of actual operation?
When we've looked at making this an opportunity available to the customers that our economic development and customer choice groups have spoken with, that's the size of a customer that's usually most interested in being able to make that decision to relocate the state with this. And also when you're looking at the financial commitment of the program, you're really looking at making sure you've got the right size of a customer in there. But it's really, that's the class of customer that's really looking at that as an opportunity and has an impact enough that we want this tool to be able to attract them.
Why wouldn't the 10 megawatt customer be one to attract?
It still would be good. I think this is just, again, based on the not me personally, but that the company has had contacts and discussions with customers. That's the size that we felt we would be able to offer it to and get enough subscription for that 450 megawatts.
And when will the program be closed? I'm not sure I saw it in the filing.
The program itself?
Yes.
When you say closed, you mean in terms of a notice, or you mean in terms of the subscription period? It will have to be worked out in terms of the RFP. The RFP development and the solicitation and the notice of interest will all be done together. We'll still have to work through all those details, but there'll be some point in there where you'll need to know the notice and know that people have committed and paid the participation fee before you do the solicitation to know how much to purchase. We haven't worked all those details out yet, but it is something that we would have to determine.
Okay, and how far in advance would a new customer be allowed to subscribe under the program? I mean,
again, we've had some discussions around that, but all the finer details of that will have to be worked out. But obviously there has to be a time for commitment before you go procure on their behalf. But we haven't worked through all those details yet.
Okay, I'm going to move on to the next subject, which would be the capacity RFPs.
Yes.
And I just don't. I have a couple questions here. Would you agree, subject to check, there's no new natural gas plant currently in the Southern Company's transmission system active generator interconnection queue?
I don't know the full interconnection queue. You said no new one from within the last how many years?
Currently.
Yeah.
And that's natural gas.
Okay, I mean, I don't know that for sure, but I doesn't surprise me. I haven't heard of any new ones.
So you would agree subject to check?
Yes.
Okay. Would you also agree, subject to check, there are over 8,000 megawatts of solar in the Georgia queue, which would be available by 2022 or earlier?
Subject to check. I know there's a lot of interest and a lot of requests out there.
How does Georgia Power expect new natural gas capacity to bid into the 2022 capacity RFP and circumvent the queue process?
We do not, and we've stayed in the main filing that the 22 and 23 RFP would be based on bids or acquisitions for existing resources. So we do not expect any new resources to bid into the 2022 or 23.
And I guess where would you think those existing resources would be located?
Well, there are some uncovered assets out there. We'll have some PPAs that roll off between now and that time. So I know there's some other entities that have gone out and done solicitations, but there are uncovered assets out there, ones that roll off contract that we expect to bid in.
Will the company use multiple costs and benefits to justify selection of specific projects before the commission, or will capacity be the only variable considered when seeking a CPCN or other approval from the commission?
Could you go through that one more time? I'm sorry, I want to make sure I follow it.
Yeah,
And you're speaking again about the capacity solicitation?
Yes,
okay.
Will the company use as a justification multiple costs and benefits to justify selection of specific projects, or will capacity be the only variable considered when seeking a CPCN or other approval by the commission?
I'll let Mr. Weathers add on here as he may, but we've talked about this a little bit yesterday, I believe. when we, again, this is if we recommended to retire Plant Bowen. We would do the RFP, and what we'll look at is when we evaluate the system, we will look at what the benefit to the system in terms of projected avoided costs to customers are for the different bids. Part of that will be obviously the capacity contribution, and we have to have firmness there. So economics will be the main driver of that decision.
Yeah, absolutely. I think capacity will be, firm capacity is what we're looking for. That'll be a requirement. We will evaluate all the costs and benefits of proposals that are bid in.
Will fuel costs be considered?
Yes.
Yes.
How about ramp rate?
Possibly. It depends on the different resources that are being bid in.
About frequency or voltage regulation?
Well, I'll let these two gentlemen add on if they need to. When we procure generation, we expect to get the capacity, energy, and all the ancillary services from those facilities that we contract with or acquire.
So let's just say in the case of, I'm going to ask you about fuel diversity as a factor, but I mean, if all the resources that you end up considering could be one type of resource, is that a concern? Is that something you would be looking at, that there's fuel diversity there?
I'll say it's a consideration. We'll have to see if it's a concern or not. And again, we're looking at options if we recommend retiring Plant Bowen 1 and 2, and we'll make recommendations to this commission. And so in our recommendation and in the commission's consideration, that would be something we would look at.
And how about fuel hedging as a consideration?
Fuel hedging in terms of, we would refer to it more fuel diversity than fuel hedging.
Let me ask you a question about Plant Bowen 1 and 2. You remember when you retired Plant Branch, and those units were mix match. All 4 units were different, I think different manufacturers, and there was some problems with doing the upgrades. It's going to be very expensive. Is Bowen 1 and 2 in that same situation? They're the oldest units who may have some out-of-date parts, pulverizer that maybe doesn't work as good as the other, or is it, or are all those units the same?
So 1 and 2 are similar in terms of heat rate and age. I think there's a little bit of difference, but they are very similar units. And then 3 and 4 are bigger and newer. So in the past, Commissioner, we've always studied all 4 of them together as a plant. And as the economics got a little more pressure, we wanted to split those out because 1 and 2 are very much the same units, and then 3 and 4 are very similar as well. So it's not like Branch where they were all different, but as those pairs, the pairs are different, but within the pairs they're very similar.
Will the company, would capacity from other Southern Company subsidiaries be allowed to bid into the capacity RFP?
Yes, from our wholesale affiliate, we would intend to have the RFP process done like it has been in the past with the independent evaluator and following commission rules to allow our affiliate to bid in, mainly because that is an opportunity to make sure we're getting as many bids as we can to see what's the best for customers.
Okay. Will the company commit to using an updated renewable cost benefit framework for evaluating proposals in the capacity RFPs?
We would, in terms of whenever that evaluation is happening and what the latest renewable cost benefit framework is, if we get bids from a renewable plus storage bid. So
if it wasn't plus storage, that would not be part of the evaluation?
That's correct. For the capacity requirement, the capacity RFPs, when you're looking at potentially retiring Plant Bowen, that is a firm capacity solicitation. We would want a certain measure of firmness from any bid. That'll be determined, but it needs to be several hours of firmness at minimum.
Now I'm going to turn your attention to some questions on storage.
Okay.
With regard to the 50 megawatts that the company has in its IRP, how much, and I realize it's not 50 megawatts, well, it could be 50 megawatts one unit, but I think I heard you earlier testify there's going to be multiple units.
That's right. We do not plan on one 50
right.
megawatt storage. It's at least 2, with 30 being the maximum on either of those.
Okay. I guess the question is, and maybe you sort of answered that there, how much energy capacity will these units have, and will the batteries be lithium ion?
Generally speaking, the technologies that we're looking at today is lithium-ion batteries, and we're looking at 4-hour energy storage as the capacity component.
And what's the basis for that? So 4 hours, I guess?
Generally, it's a fairly standard use case that we see in the utility industry today. And it allows us to test it in multiple ways. We can actually run that battery and split it up, have 1 hour type operation, and then use the other components, other hours for different use cases. So it gives us a lot of flexibility to actually evaluate the operational and use case impact.
Is that 200 megawatt hours? Essentially 50 times 4?
That's correct.
Okay.
Again, split amongst a few of them, but yes, in
Gotcha.
general, yes.
Okay. We didn't see anywhere where there's an RFP being offered to acquire this storage technology. Why isn't the company issuing an RFP in this case?
Yeah, and we've spoken to the the company wants to own these resources so that we can test all these various use cases, and we really need to understand our system, and our operators need to get experience with it, and we feel like ownership is the way to get all those use cases evaluated, not through a purchase power agreement or an RFP.
And can't you own it through an RFP? I mean, RFP to buy.
I mean, we've really talked about this at length yesterday. I mean, you may not like their response, but I mean, we got into a lot of detail on this.
I'm not sure I like or don't like the response.
Well, and that's fine, but the response is the response. I mean,
well, I'll move on to the next question. I still think where we are hasn't been necessarily fully covered. It appears that the company is claiming that energy storage needs testing. Does that not suggest that the company may be unfairly evaluating storage for the CRSP and capacity RFPs?
Again, I'll let Mr. Weathers and Mr. Bush jump in here. That is not the case. What we're evaluating in the framework is the use case that the bidders have proposed in terms of how they would use the storage. And so we would have a profile that we're evaluating in those. What we're looking at on the battery energy storages is testing all those different use cases. So it could be something that we're able to use going forward to provide bidders with better information on how to more leverage storage in those bids. But we are evaluating it correctly. But again, we're getting that bidder's use of that storage. What we're looking at in our early deployment is testing all those different use cases.
Yeah, and those storage in the ready RFP that you mentioned, those are paired with a renewable resource because it's a renewable energy RFP. And so that we're properly evaluating based on the profile, the bids that they give us, what the benefits and cost of that is. But this, as Mr. Bush and Mr. Grove both said, this includes at least one application in the 50 megawatts that would not be paired with a renewable plant.
Seems like the military would be very interested in this 50 megawatts and putting it on one of those bases or a couple of those bases. If you had any conversation that you're able to share about that?
I don't think we can give a share them. I'm not sure if we've had those conversations, but we've had the same thoughts you have, Commissioner.
Okay, that ends my cross, and I just want to thank the Commission for allowing me to cross these witnesses, and thank you, panel.
Thank you very much for your participation. South Face Energy Institute.
Thank you, Mr. Chairman, Commissioners, distinguished panel. My name is Steve O'Day. I represent South Face Energy Institute and Boat Solar. To my left are Lisa Bianchi-Fasadi from South Face and Katie Ottenweller from Boat Solar. And I am literally the tail end of the tail in these last 2 days.
No, you're not yet. There's a lot of day left.
A lot of day left. Okay, got it. I realize that I am entering fields that have been well plowed over the last 2 days. I do see some furrows that are not quite complete, so I'm going to ask some questions that I hope are not repetitive of earlier questioning. I will do my best to avoid that, but
I'll
I do
help you.
appreciate your indulgence.
You don't have about 5 Snickers bars you could share with us, do you?
I wish I did.
No, okay.
Wish I had about 6. Dr. Smith, I felt like you didn't get equal time yesterday, so I plan to start with you, although I think you've made up for that today.
Made up for it today.
Today I have,
Yes.
You talked a lot today about the income qualified crowdfunding program.
Yes.
My question is, by what metrics do you plan to evaluate the success of that program?
I think we would evaluate the program just like we evaluate any other program once we pick a third-party evaluator and it goes through the process that the other programs do. And the metrics against which we will measure the success of the program will determine at the time.
Do you know what those metrics are? Do you have an idea today of what those metrics are?
I cannot speak to those today.
Will the company establish those metrics, or will the evaluator, or a combination?
It's a combination.
Do you have goals that you have set for that program that the metrics would be used to measure?
So we do have kilowatt hour goals for the program, and we have a general design of the program that we filed. It's in both in our program planner and some of the appendix material that we filed in the docket.
Now, I think you mentioned earlier that you were choosing DSM programs in a way to get the biggest bang for the buck. Does that imply that you've got some limitations in your budget, in your budgeting for the DSM program?
I think I did mention earlier how we come up with the kilowatt hour targets, and that is really following the commission order and commission's methodology of balancing the economic efficiency of those measures with great impacts. So once we agree on the kilowatt hours, then there's a budget that we design to achieve those kilowatt hours. So to that extent, once we do that balancing, we stick to those kilowatt hours and an implied budget.
All right, and I
So
recall,
let me just add, so within that, you want to get the biggest bang for the buck.
and I recall you talking about maybe some trade-offs when you're talking about the $2,000 cap per house. And you were talking about balancing how deeply you go in a particular house with how many homes you can reach. And so I guess, is it true that that's based on a limited budget? If you had unlimited, you wouldn't have to do that, right?
That's correct.
Okay. Now, you said in your testimony that the income qualified program is designed to meet energy efficiency needs of a population that is historically underrepresented in
Correct.
the program. So that makes me think about your pilot program. You have proposed a budget of $2 million for residential, $2 million for commercial pilot programs, right?
Yes, annually.
And did I hear you yesterday say that $400,000 of that budget was anticipated to be used to evaluate existing pilot programs?
That's correct. As we wrap up the existing pilot programs, we will use some of that budget dollars in the next period to evaluate the success of those programs.
The success of the existing programs?
That's correct. Some of them, yes.
Which programs are those?
So one that I can tell you off the top of my head is the water heater demand response program that we talked about. There are a few others as well that we would be including in that evaluation.
Now, you have DSM programs in your inventory that you know work, right? You know you spend some money on, you're going to get efficiency reductions out of them. They're proven programs, right?
Yeah, based on our experience, that's right.
And we just talked about how your budget for those programs is limited. You can only go so far because of your budget, right?
Because the budget that is driven by our kilowatt hour targets. That's correct.
And you're proposing to spend $4 million on programs that are unproven, correct?
That's correct. They're unproven currently, and we are doing the pilots to ensure that we look at the capability of those programs to effectively provide the kilowatt hour savings.
could you reach more homes or get deeper into the homes that you do reach by allocating some of that $4 million towards the income qualified program to allow either a higher cap or more homes?
You know, that's always a possibility, definitely. And I should say that as a part of the pilot budget, we will also pilot some low-income focused programs as well. So to that extent, some of the pilot budget will go to benefiting low-income customers, either in terms of future programs or some of the impact of the pilots.
You talked about the historic underrepresentation of the low-income households. Do you, in your evaluation of your programs, either with your evaluator or internally, do you evaluate your marketing success or lack thereof? In other words, whether you reached the low-income households and they turned you away, or whether you have not been able to reach them? Have you looked at those issues?
I mean, I don't know the details of exactly what aspects of the low-income programs those evaluation reports have evaluated. I would have to check on that.
Do you know whether the inability to actually get energy efficiency improvements in those low-income households is because they were not actually reached with marketing efforts, or because they were reached and didn't like your product and so they said no?
As I said, I would need to look at the evaluation reports to answer that question.
Right. Now, in your testimony, you said that you project that the proposed, your DSM programs as a whole, will result on average in about 170 megawatts of demand reductions and 375 gigawatt hours of energy reductions annually for 2020 to 2022. Is that right?
That's correct.
And you said that in your testimony, you said that was based on planned implementation levels. You recall that phrase?
Yes.
I wanted to ask you what you meant by planned implementation levels.
I believe that means that we are basing those estimates on our program plans that we filed with this IRP. And earlier we spoke about the fact that those program plans are concepts, and it's based on our past experience, the assumptions that we have in those plans. And once we pick an implementer, we will finalize those plans. At that point in time, it will be more clear how we're exactly implementing those programs. So from that perspective, planned is our current best guess at how we will run those programs.
Okay. In your testimony, you talk about how you're going to evaluate, with your evaluator, your DSM programs as a whole. You spend a couple of pages in describing that. I wanted to ask you if you're familiar with the practice of measuring a utility's overall DSM performance by calculating the ratio of the total DSM energy savings to the utility's prior year retail sales.
Could you repeat that? Just
Sure.
It was a little long.
Okay, I apologize. Are you familiar with the practice in the DSM industry, let's say, of measuring a utility's overall DSM performance by calculating the ratio of the total DSM energy savings to the utility's prior year retail sales?
I got you. Yeah, that would be a metric that maybe some of our peers might be using, yes.
Have you ever used that? Has the company ever used that?
We actually, we haven't used it as a metric, but it's a very simple calculation of taking your kilowatt hour savings that you're targeting in your DSM programs or you've achieved and dividing it by whatever year of kilowatt hours you are producing for the customers.
Are you aware of what the DSM proposed case, of what percentage of prior year retail sales your DSM proposed case would reach?
I didn't calculate the prior year number, but I would say that if you look at just the annual reduction going forward for the corresponding year, it's a little less than 0.5% of retail sales, yes.
And you spoke earlier about some of the other electric utilities in the South. Are you aware that other electric utilities are able to reach as high as 1%?
That's correct, and in fact, I think we had a conversation about that yesterday as well.
Yes, and there was a conversation earlier today about whether or not you look at those utilities programs, so I'm not going to repeat those questions. But what I did want to ask is, have you identified any programs that those utilities are using to get to those 1% levels that you considered for this proposing in this RFP?
As I said earlier, we do look at the programs that are being implemented elsewhere in the nation. Although to decide how much DSM this company does, we do follow the commission policy. So it's really not a function of what programs you put under to achieve those kilowatt hours. That's independent of what programs we will be achieving, not completely, but really you're looking at the balance between upward pressure on rates and economic efficiency, as I said a few times earlier.
I don't want to echo something Commissioner Eckel said earlier, that you have proposed an innovative program here, this crowdfunding income qualified program.
We'd like to believe so.
Have you identified any other innovative programs that these other utilities that are reaching 1% have implemented, and you looked at them and turned them down for this RFP?
I don't know which ones we've turned down, but I could say that the tariff-based, income qualified tariff-based pilot that we're actually proposing for this time around are learnings from other utilities and also conversation with the DSM working group.
And I want to get back to that, what you just said a moment ago, just now, but I want to get back first to the first part of your answer. You said, are you saying that you do not know whether there were innovative programs in other utilities that were identified and turned down in your evaluation?
I believe there are likely multiple programs out there. I am not involved in researching those programs. My group focuses on evaluating economic aspects of the DSM program, so that doesn't mean that the energy efficiency group has not done it. But I am not aware of particular programs that we looked at and turned down.
We make that a hearing request, Mr. Chairman.
Be fine.
Could you, I almost forgot the second half of your statement, and that was you were talking about the income qualified tariff program. Pilot.
Yes.
There was a lot of discussion this morning about this, the $2,000 cap under the crowdfunding program per house. And I did notice, though, that in the tariff pilot, you had a cap of $7,500 per house, right?
Correct.
Why the difference?
There are two different programs. One is the pilot, one is the certified. But with the pilot program, we are actually having the customers pay back to the company utilizing that commission-approved tariff of the investment and installation cost of the improvement. So the company is actually getting back the investment. The other programs are based on rebates and those types of things, different measures. And we are able to achieve deeper savings with the $7,500 cap and income qualified tariff-based program.
So does that $7,500 cap, does that recognize the potential need for spending that much on EE and other efficiencies in low-income households?
That's correct.
All right. In your testimony, you said that the company intends to recover the costs of DSM measures and installation through the income qualified tariff, that is from the customers themselves, and to recover the program administration costs, education and awareness campaigns, oversight and evaluation through the residential DSM tariff. Is that right?
That's correct.
And the complete breakdown, I believe, is in Appendix H. If you have that in front of you, you could refer to it. I'm not sure you'll necessarily need to, but probably will, though, because my next question is, what is the total proposed budget for the DSM measures and installation costs?
The overall budget is $6 million in the course of 3 years.
Okay, so I'm talking about the pilot. We're talking about the pilot.
That's right. So Appendix H, income qualified tariff-based financing costs, and if you look at the overall cost, it's about a couple million a year, so that's about $6 million total.
Okay. And what what is the annual budget just for the measures and installation?
That's one. Yeah, that's you're talking about the incentive piece of it. That's about $1.5 million in the course of the 3 years, and we talked about that earlier as well.
All right. I also saw in your testimony that you are planning on carving out $500,000 for income qualified customers in the residential HEIP program. Is that right?
Correct.
Now, is that carve out? Do you continue to intend to dedicate that to multifamily housing, as it has been in the past?
Yeah, the plan is to continue as we have in the past.
All right. You've also testified that the proposed DSM case will yield $118 million annually in the total resource cost. You talked about that a good bit here.
Yes.
Right? Does that positive TRC result mean that those DSM programs are economically efficient?
That's correct.
And you talked about the upward pressure on rates of the 238 million, right?
Yes.
Okay. And that you said that was measured using the RIM test, the rate impact measures test.
Yes.
Could you tell us the costs that are considered in the RIM test?
That's right. I can. So on the benefit side, we're looking at the avoided cost on the utility side of reduced electricity, and on the cost side, the cost of running the program. So it's program cost plus any incentives in there, and plus any lost revenues that the utility has because there's a reduction in usage.
So you have program costs, incentive costs, and the lost revenues.
That's right. That's on the cost side.
Of those costs on the cost side, which is the most significant?
I would say lost revenues is the most significant.
And is lost revenues, is that the same thing as participant savings?
That's correct. So that's the bill savings that the participants would benefit from.
The very object of the program.
That's correct. And I also talked about, when we talked about the TRC test, that it is an economic efficiency test, but it doesn't distinguish between who gets the benefits. It's a more kind of a socialized view. And that's the reason why we'll look at, is it good for the participants, is it good for the non-participants, and is it good for the company? So it's really all the tests that we're looking at strikes that balance.
Is it fair to say that in looking at the costs in the RIM test, the bulk of the costs are not new costs? They're not things you're writing a check for, such as incentives and installation, but they are the lost revenue?
That's correct. And that's why the impact on rate pressure for the customers.
And I know you talked a good bit today about the Program Administrator Cost Test, or the PACT test. I'm sorry, I have to revisit it for just a couple of questions.
Okay.
Do you recall what the average PACT benefit is in your proposed case for Georgia Power for the 2020 to 2022 period?
I don't recall that off the top of my head, but I can look at it.
Please do.
Sorry, it doesn't want to cooperate. Okay. Oh, I'm sorry, you said ratios. I had the numbers here, but I don't have the ratios. I don't have that off the top of my head.
I actually asked for the average benefit per year.
Oh, okay, gotcha. So if you look at all the programs, it's north of $150 million. It varies between $151 million and $157 million.
Okay, about $154 million average.
Yeah.
Do you know what the average benefit would be under the advocacy case for the same time period?
I'll do that as well. starts out around 220 million, 280, and then 234 million. It ramps up over time.
Okay, so a little over, about twice what the
That's right.
benefit is.
That's correct.
under
But at the same
proposed.
time, the rim is more than twice as well.
Okay,
So,
we're gonna talk about that in just
Okay.
a second. I do wanna talk about this, your testimony about upward pressure on rates, which you get from the rim test, right?
that's correct.
In the 2016 IRP final order, the commission directed Georgia Power to work with staff to develop a methodology for calculating the long-term rate impacts of DSM. Is that right?
That's correct.
And Georgia Power filed a calculation of the long-term percentage rate impacts for the 2019 DSM program cases. Is that right?
Yes, we filed that.
Now, I realize there are trade secret values in there, so I don't want to talk about specific numbers, but I'd like to try to characterize the findings of the impact analysis. It might be helpful, though, to use some numbers that you are somewhat familiar with. So are you familiar that the current nuclear construction cost recovery rider is set at 8.409% of the base bill?
I am familiar with that number, yes.
And would you accept, subject to check, that works out to about 5% of the average pre-tax residential bill once you take into account the fuel charge and other items?
I mean, I haven't made that calculation, so I don't know.
You could check that, right?
We could check that.
So, assuming that that's the number, which you can check, we'll take that 5% for the purpose of the next few questions. Looking at the first 3 years of the company's long-term rate impact analysis, could you implement the proposed advocates case portfolio of the DSM program, achieving a deeper energy savings than in the proposed case, while keeping the rate impact well below the 5% rate impact of the NCCR, right?
I would say the percentage that you indicated, yeah, that's an accurate characterization, but we also discussed earlier that comparing DSM against a unit like a nuclear, which is a baseload unit, is not a fair comparison, because you're comparing it on only aspect on the cost side, but the benefits that you're getting from those are not the same.
And I understand that. I'm only using the comparison because I don't want to state the specific numbers because they're trade secret values. So I'm trying to get a range, and the range would be well below that 5% range, wouldn't it?
I wouldn't say it's below the 5% range on the aggressive.
No, the
I'm sorry, the advocates
case.
case. No, I think that the rates are pretty significant.
Are they below 5% of the average customer's bill?
Well, that's not an average customer bill type of analysis. That is really rate impact on top of our reference case, supply case. So I don't think comparing those numbers, which are the rate impacts over and above our reference case, is a fair comparison to comparing what we have in a customer bill. Because these are not customer bills.
Okay, and
That's a reference case, and that there's a cost associated with that reference case. And the rate impact measure, which is the same, has the exact same components as its percentage numbers that you have referenced, is looking at the rate impact over and above our reference case.
Have you made the calculation of what the percentage rate impact would be on the average customer's bill of the advocacy case?
No, we have not analyzed customer bills.
Okay, so you also testified that the DSM portfolio will represent approximately 1,600 megawatts per year by 2022.
The existing portfolio currently, yes.
And does this mean that that portfolio is capable of yielding 1,600 megawatts of peak demand savings?
That's correct.
Looks like from your testimony that 107 megawatts of the peak demand reduction is associated with the certified energy efficiency programs proposed by the company in its certification file.
So what I would say, those are apples and oranges at this point in time. The 1600 megawatt represents the programs that we already have approved by the commission and we're planning on currently. So part of it is the DSM programs that has been approved by the commission, and they're that's a part of our plan going forward, and accumulated impact of those to 2022. On top of that, we had the demand side options that we earlier talked about that I won't get into right now. But only part of that 1600 megawatts is the DSM impact, which is our traditional certified programs, and it is not the proposed, it is the existing plan.
Okay. What part of the 1600, how much of the 1600 is not resulting from the certified programs?
I would say more than half is resulting from other demand side options, like pricing programs and interruptible supply.
Would those be the ones that you listed on page 37 and 38 of your testimony where you talked about the
1600 megawatts? Yeah, that's what it would be.
Okay.
And let me just clarify, just to make sure everybody understands. When we make an adjustment to the forecast for these types of things, the adjustments are done for only things that are not in our history. So we have been doing these DSM programs for a decade now, and that becomes a part of the load, and any impact from those are reflected in our forecast. But when you look at from a point in time and what we have approved by this commission going forward, we calculate the adjustments for the programs that haven't gone in place yet, but have been approved by the commission because they're not in our history. So the overall impact of DSM programs are much bigger. These are just the external adjustments because the data is not in our history yet.
Okay. Well, of those, and of the more than half that you said come from the non-certified programs, can you attribute any part of that to each specific non-certified program that you mentioned in your testimony?
So do you want me to break down, are those trade secret? I'm not sure if those numbers are trade secrets.
I don't know either.
Yeah. So let me look at the
just to be sure we're talking about the same thing, are we talking about real-time pricing, demand plus energy credit,
Yes.
demand tariffs, and time of use tariffs?
Yes. Yes, those are trade secret numbers. But I think I indicated that if you look at that 1600 megawatts, more than half of it is made up of those programs.
You testified yesterday, and I wanted to ask you a few more questions about it today. You said something about active and inactive DSM programs.
So active and passive.
Active and passive.
Yes.
What do you classify as active DSM programs?
Active DSM programs are, by definition, measures that you can actually activate and see the impact. So those are our extreme real-time pricing response, conservation voltage reduction program, power credit program that we talked about earlier, and interruptible supply, so our DPEC program that we also talked about earlier. Those are our demand side options, in other words.
And the passive ones would be all the rest?
All the certified programs, yes.
Now, prior to the 2016 RFP, my client, Southface, and its partners estimated there were more than 470,000 multifamily affordable housing units in the state, and that they represented about 12% of Georgia's housing stock. Do you have any knowledge about the number of units approximately and the approximate percentage?
Not off the top of my head, no. I haven't been involved in that.
Assuming that to be the case, and assuming that more specifically it was estimated that Georgia Power's service territory contains about 399,500 multifamily affordable housing units, representing 85% of the total in all of Georgia. Now, those are units that you would be seeking to reach, some of them you'd be seeking to reach with your DSM programs, right?
That's correct.
You have said in your testimony that the DSM program plans included in the application represent a well-balanced portfolio of residential and commercial DSM programs that are structured to help customers reduce and better manage their energy usage. Is that what you feel?
That's how I feel, yes.
Now, would you say that the proposed behavioral programs are an important part of the endeavor to help customers better manage their energy usage?
You said behavioral programs?
Behavioral,
Yes.
And in a multifamily residential context, the residential behavioral program will engage individual occupants, right?
Yes.
Would you agree that the automated benchmarking tool, which you have had in place but are planning to discontinue, is designed, in fact, one might argue, uniquely positioned to help a multifamily residential building owner to better manage their energy use at the whole building or property level?
I mean, I would agree that potential is there, and we also talked about that tool yesterday. And one reason why we believe it's not customers' money spent well is because the number of users, unique users on the program, on the tool, was in the order of 3. Those are our major users. So over, I guess, 80–90% of the access to the tool was by those 3 customers. So if you think about that being paid by overall commercial customer base, we didn't feel like that was a good value proposition.
Was that 3 customers?
3 unique customers.
Or 3 individual housing buildings?
Customers. So for example, a city would be a customer, and that would have multiple buildings.
Did you evaluate why that ABT had only reached 3 customers?
We haven't made that evaluation at this point in time, no.
So did you evaluate whether you could modify it in some way to reach more users as opposed to just discontinue it?
We did not do that evaluation either.
All right. You mentioned it some yesterday, and it's in your pre-filed testimony that the company's avoided cost has decreased since the 2016 IRP, thereby weakening the DSM program economics, right?
Correct.
Now, you're aware that each year the company files a 10-year all hours avoided cost projection in Docket 4822?
Yes.
The most recent forecast was filed just last December, right?
Yes, for 2018, that's correct.
Over the coming 10 years, does the forecast show that the avoided costs go up or down?
I've got it in here somewhere. I believe it does continue to edge up a little bit.
So between 2018 and 2028, you said you're looking for, do you recall off the top of your head how much it increases?
I don't.
I'll let you find it then.
And I would say that that avoided cost would be basis for our evaluation of our current DSM portfolio.
Go ahead and speak some while I'm looking. The issue, what we've mentioned too, though, is it's not necessarily the trend within an avoided cost projection. It's the projections from our planning process. So if you think about 2016, that same 10-year projection in 2016 compared to the same 10-year projection in 2019, that's moved down. It's always our avoided costs have always had an upward slope, usually because of expected increase in natural gas prices and then also load growth. So what we're talking about, though, is the overall range of that trend.
So you said the avoided costs are still going up, they're just not going up as much as you projected in 2016.
That's correct. Or the basis has moved down.
That's right.
And so we've got an escalation to it, but it's a lot lower than it was. We're on the magnitude of probably 50% lower than 2016 when we look at our avoided energy costs.
All right, now we've heard the two words, additional sum, a lot today, so I'm not going to cover all that ground again. But what I wanted to ask is, does the company have an objective standard in mind related to how much additional sum it should get for its DSM program, such as dollars per kilowatt or per megawatt, or dollars per peak load, avoided peak load, or something like that?
I mean, to base our current assumptions, we looked at the amount of additional sum that the company was approved in the past. And I think I spoke about it yesterday, that it ranges between 29 versus, I guess, 29, 30 million to $15 million. And we designed the current methodology to be on the bottom end of that. So that range represents reasonable amounts. And I would say that throughout that time frame, our kilowatt hour savings has been fairly comparable. But the additional sum amount not only declined over time because of economics declining and avoided costs is declining, also the alignment between residential and commercial got worse over time. We talked about economics of residential programs being more challenging than the commercial programs. And we also talked about that in this last stipulation, the commission ordered us to do all we can to make sure that residential class represents about 25% of our overall portfolio. So we're encouraged to do more residential programs. But because the economics have declined over time, the additional sum has declined significantly. So we felt that this cents per kilowatt hour measure aligns how much you save from each class to the additional sum that is collected. So incentives are aligned with the kilowatt hour savings.
And I understand from the testimony earlier that the additional sum that is recovered by Georgia Power on solar projects is a different calculation. But is there any recognized standard for how those two should be benchmarked as far as what a utility should recover for the solar additional sum, or the DSM additional sum, a common standard of some sort?
You mean between each other? And also I'd say not everyone has an additional sum, and that's something we've got here in Georgia that the commission has done that is unique to the state.
State law.
Yeah, state law. So I think if you're talking about comparing between the two, I'm not sure of any method, but having to reconcile between the two.
Yeah, and you said that earlier. I
Right.
was not asking that question. The question I was asking is whether you know of, is there somewhere out there that there is a recognized common standard that you could kind of measure yourself against?
Not that I know of, no.
And what the statute says is it's based on three things that I think was mentioned
Right.
earlier, is shared benefits being one, increased risk and loss revenues. So it
Right.
has to be aligned with those types of drivers.
And would you agree that the existence of an additional sum payment to the company gives the company an incentive to pursue DSM, to pursue the solar resources that you pursue?
That's right, precisely the reason why we're trying to align residential and commercial kilowatt hour savings and additional sum.
But you also want to not overtax the ratepayers who are the ones paying it, right?
That's correct.
And do you think you've achieved that balance with the additional sum, both on the DSM side and that you've requested and on the solar side?
We think our request balance, a good return for the company, and then also understanding that it is paid for by customers.
Do you have a calculation or a projection to support your position that you've reached a good balance?
The commission?
And that's what
I
I was
agree.
going to ask, whether they had a calculation that they had presented or planned to present. Have you done that?
The additional sum has a calculation on its own. The percent that we request, as Commissioner McDonald has said, is based on the commission's approval and past practice and those types of things.
I understand that. You have requested an increase this year on the solar
That's
side,
correct.
right? And a different calculation on the DSM side.
That's correct.
So you're requesting that, and you have taken the position a moment ago that you feel you've reached a good balance. And my question is, have you done a calculation or some sort of projection that gives you confidence in saying that you've reached a good balance?
No, I mean, not a calculation on the percent we're requesting. There is a calculation underneath the additional sum,
Right.
obviously. But as Chairman McDonald said, it's really based on the commission.
And we have various sharing mechanisms in other areas of our company as well.
That's correct.
That includes the the earnings mechanism where we share 1/3 with the customer. Actually, we keep 1/3 and share 2/3 with the customer. There are some types of sharing
That's right.
mechanisms in terms of DSM programs and renewables. It's less than that, but there's not an objective number that we can say this is what we solve for.
That's right. To Dr. Smith's point, we share on any kind of short-term capacity or energy sales with customers at a much higher rate for the company than the additional sum.
Do you know how much the company has been paid in additional sum each year for the solar PPAs?
I do, but it's a trade secret number, and it differs for every one of them because it's based on the projected net benefit of each contract. So it differs.
Can we make a hearing request for that documentation?
Are you certified for trade secret information?
We have a confidentiality agreement with the company, so yes.
Then okay.
So the request again is for the projected additional sum on the solar PPAs?
Projected and for the past 3 years.
Yeah, I believe we would have that.
Under the CRSP program, I think I'm letting you off the hook for now, Dr. Smith. Under the CRSP program,
Yes.
who, as you proposed it, from whom does the company collect the additional sum?
For the subscription term, it would be from the customers who are participating in that program. Once those terms are over, it would be collected from the remaining customer base.
Now, there was some discussion earlier about low-income access to solar resources.
Right.
And I think it's centered around the fact that you've determined that solar resources do provide a cost benefit to ratepayers, those who are able to take advantage of them, right?
Depending on the acquisition cost, yes.
Yes. And the question I have is whether you could structure the CRSP program or modify what you have proposed in some way that would provide a fund or a backstop to help low-income people have access to solar as well.
For the CRSP program, we really are focused on, again, those customers who have come to us with specific requests to have a program of that nature. For the smaller customers, we've got a lot of other options. I think the question this morning was around community solar. And so we're really focused on your larger customers who need some options that don't have as many options as the smaller customers do, who could do simple solar, community solar, or add them for themselves. So we have not looked at, that I'm aware of, any low-income specific solar program.
And I'm going to ask you about community solar in a minute, but what I was asking really was, these are customers that come to you and say, we want solar for our load, right?
Well, it's a combination of that, and then also these are the corporations that have sustainability goals that are really looking for those options, and the IRP is the manner in which Georgia Power can help in that regard.
And the result of that, particularly at the 25 megawatt level, the result of that is lower rates for those customers, right?
Well, it depends. The customers will continue to pay their electric service bill just like they always have. What they're doing is paying the price of those PPAs to get an hourly energy credit on how that solar actually generates and gets a credit for that marginal cost. So I don't know if the customers are doing it just for that or if they're doing it for kind of an additionality and a corporate goal. But that was really the main driver. It's set up for that hourly energy credit, but they are paying the cost, an administrative cost and the cost of the PPA in additional sum during that subscription term.
And these customers that you're talking about, they have social responsibility goals, and so they're wanting to meet those by, for example, procuring renewable energy.
In general, yes.
And others of their social responsibility goals are to help the community in which they operate, including low-income residents in the community, right?
I can't speak for everybody, but I'm sure there are those that have those, sure.
And would you consider, as part of your program to help these companies meet their sustainability goals, including their community-related goals, including as part of the CRSP program, some some percentage of their savings that would then go to assist low-income customers.
I don't design the program, and I can't speak to what those participant customers want to do with that. I don't know what they're doing with what they're claiming for those, and we are retiring the RECs on their behalf. So I can't speak to what the customers that participate would do.
And I know you can't, but you will never know if you don't ask, right?
That's true.
Okay. All right. Does the company get an additional sum for behind-the-meter DG deployment?
We do not.
What about DG that's in front of the meter but not competitively bid?
We have not, for a not competitively bid DG, they are paid at projected avoided cost, so there is no net benefit to base the additional sum on, even if we were.
I have a few questions about the RCB framework, and I know that we've covered a lot of ground on this one as well.
Okay.
But, first thing I want to ask is there any value for RECs in the RCB framework?
No, the RCB framework, as we've talked in the past, we're trying to identify all of the costs and all of the benefits associated with the incorporation of that resource into our fleet. And currently there is no cost for a renewable energy credit for our customers in the state of Georgia.
Right. So in the history of your solar procurement, under ASI, you were procuring solar resources, and you said that the developers kept the RECs, right?
I believe so, in ASI is correct.
Yeah, and then in READY, the company made it part of the requirement that the company would get the RECs, right?
That's correct, that we could retire on behalf of all customers.
What changed between the two?
I can't speak specifically to it. I think it was just more of a understanding around the treatment of RECs. I mean, there's been a lot of learnings in terms of what you can claim with or without a REC. You know, we only claim carbon emissions and those types of things for ones we own RECs with, and the others we don't own. So there's certain things there that we've learned over time. But again, we haven't sold those. We've retired them on behalf of customers.
Did the PPA prices go down on average between ASI and READY?
They have. I wouldn't know if that's based just on RECs. I think that's more based just on the continued lower pricing for solar. I can't speak to how a bidder incorporates a REC value into a PPA that they're giving Georgia Power the REC. I assume they take that into account, but I don't know exactly what point they do.
And along the lines of you don't know unless you ask, if you had offered a program in which they could either keep or sell the RECs to Georgia Power, you would know whether or not there was a value that they assigned to those RECs, right?
We could, but again, we have begun to require the RECs to be turned over to Georgia Power to retire for all on the behalf of all customers. So that's something we've been wanting in the last several solicitations.
Which means you don't know whether they assign a value to the RECs or not.
I don't know what they do. I know that they bid in a price knowing that we're going to get the energy and the capacity contributions and the RECs from those contracts. But what value they give them, I don't know.
Now, in the RCB framework, does the company assign any value to the ability to control smart inverters?
We don't have anything specifically associated with the ability of a resource to have or control a smart resource, but we do recognize there are intermittency components of a renewable resource.
And is it a benefit to the company to be able to control the inverters, a smart inverter?
I think it'd be dependent on the design of the smart inverter and how what all was incorporated in the design of the smart inverter and how much control the company might have.
You're saying there can be benefit, depending on how much control you have.
It seems like there would, the amount of control that you would have, that could be a benefit.
But that's not, there's no, as you said, no value assigned specifically for that in the RCB framework.
And there's no requirement for a smart inverter in our PPAs today.
You have some though, right?
I'm not definitive on everything that we have.
There were some questions earlier about resilience, but I don't think this one was asked. Do you assign a value to resilience in the RCB framework?
No, we do not.
Does resilience have value to the company?
I would say, qualitatively, sure.
Qualitatively. And do I understand correctly that most of the value in the RCB framework comes from the avoided energy and avoided capacity values?
Actually, far and away, most of the value in the RCB for the profiles that we've evaluated generically are the energy components. So the vast majority is energy.
Energy, okay. All right. All right. You're off the hook now. I'm finished with RCB. In talking about, and I think you mentioned just a moment ago, talking about access to solar, one of the things you mentioned in your testimony was the R&R tariff.
Correct.
And are you aware that the R&R tariff incorporates Georgia Power's obligations under the Georgia Distributed and Cogeneration Act?
Yeah, that is our methodology for meeting that requirement, as I understand it.
And so you are familiar with what the law requires Georgia Power to do?
Somewhat familiar. I'm not in renewable development, but I'm somewhat familiar with the fact that it's a sizing restrictions, and our application is the R&R tariff.
Yeah. So the R&R tariff is what the company has done to purchase energy from facilities which it has to purchase from under the Cogen Act.
That provide for the excess energy provided to our system, yes.
And you said the R&R tariff is always out there for people that have solar facilities on their homes or businesses.
As long as they're meeting those size requirements on the RER.
And is it your understanding that Georgia Power purchases that energy on an open, uncapped basis?
When you say an open, uncapped basis, you mean in terms of from that customer?
Yes.
I believe as long as they meet that, the facilities meet those size requirements, yes.
Yeah,
I think overall R&R has a total subscription amount that we have not met yet in the tariff, but in terms of an individual customer, I believe it's not capped as long as the size of the facilities meet the requirements.
Are you aware of how close you are to the overall cap?
I think if we project what we're seeing now, we're a few years away from hitting that cap.
The customers under the R&R tariff, how is their credit being calculated?
So the credit for any excess energy they put back on the system is based under our filing in Docket 16573, which is a solar avoided cost based on a DG profile and applying the certain components of the RCB in terms of distribution losses and then the production costs associated with support capacity.
So the company nets the exports from the generation against what they then use on site, right?
No, the R&R is for whatever is put onto our system, so the excess. So if they've used that solar power to serve their own loads, then we don't see that. It's just the metered amount that's provided back to the grid that helps serve other customers, and that's that solar behind the meter RCB payment.
And that's a metered amount above what they use from the grid, right?
Yeah, it's a net.
It's a net.
Whenever they're pushing back onto the grid, that's correct.
And is the company performing that netting over a month or a day or what period?
I believe it would be more frequent than that. They're paid an annual projected value for any of that excess.
More frequent than a day?
In terms of how often we're measuring it?
Netting it.
I mean, if it's putting onto the system, I think we would be.
So every
it's a bidirectional meter, so we would know when it was pushing excess back onto the system.
Yeah, so you're pushing excess, but then they're also later in the day or later in the month using more than they're pushing out, right?
Sure.
And what I'm asking is that netting done over that monthly period, or is it done over a day period, or?
I think we, in terms of payment to them, are accumulating that credit because I know that we accumulate how much excess they have in terms of paying them back. I can't remember all the specifics, but it's detailed. But as far as tracking when we would pay them and how many megawatt hours, it's based on whenever it's pushing excess to the system.
And what you pay them for is at the RCB avoided cost, right?
It's the solar weighted RCB price under the 16573 docket.
But what you're netting against, what they're taking off the grid, is at retail rates, at their ratepayer rate, right?
Well, yeah, I mean, because what they're doing is they're taking service from the company. They're supplying part of that with their solar facility, and they may, if they are supplying more from that facility than they're using, then it pushes back out to the grid, and that's what we track.
How long has the company been performing this netting on less than a monthly basis?
When you're saying the netting, you're talking about as far as payment. I don't know exactly I can't remember the details on when we actually pay the credit back or how the customer trues up with that. So your question again is how often we've done it more than frequently. I mean, I think we're keeping track of it daily. I'm not into the specifics of that.
My question is, how long have you been keeping track of it daily as opposed to monthly? That is, measuring the net energy used from the grid and measuring that against the net energy exported to the grid.
I don't know if we've changed it since we've been doing R&R, and I can't remember exactly all those specifics.
Do you know whether that period of performing the netting, whether that's specified in the tariff or not?
I'm exactly where I'm flipping. So, just 1 second, please. I'm not sure if it states. I don't see it where it's stated in here in terms of how we credit it back or anything like that.
Based on your
Something.
understanding, I'm not asking you for a legal opinion, based on your understanding, do you think that process that you just described comports with the obligations under the Cogen Act?
I can't speak to those specifics. Sorry, I don't deal with it every day.
I'm now going to the, hold on a second. There was some testimony. We're talking about the size of the CRSB program that, or of the solar program, total solar 1 gigawatt size. And there was some testimony yesterday that one reason for limiting the size was because the costs of procuring solar continue to go down.
That's correct. The continuation of the disciplined approach that the commission and the company have done over the last several solicitations that has really benefited customers by seeing a drastic decrease in the amount of the price we're paying for that solar.
Have you done any economic projections to determine how much you think, based on what you're proposing, how much you think the price of solar will go down over the next over that 3-year period?
I think Mr. Bush mentioned that we have some projections of what we think panel costs may do, but you really don't know until people are bidding it in from the market.
Yes, I understand that. Have your projections